This is a market that we still see as fairly constructive. We believe the equity market rally can continue to trudge higher.
These concentrated moves and these handful of names have really masked everything. With markets at the highs, again, markets don't have to stay at the highs.
We get caught up in the broad indices. You look below the surface, markets are only doing okay.
It just feels like there's very few bulls out there. Everybody that comes on has kind of a bearish tilt to them. And bear markets don't really start that way.
There is an unprecedentedly wide range of outcomes possible. So no longer can we think about investing around a central base case.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance begins right now, with equity futures positive by 0.1% on the S&P, coming into Wednesday on a 6-day winning streak on the S&P 500, closing yesterday for the 36th all-time high of 2024. Powered by big tech, let's talk about one of those names, Tesla. In the pre-market, just a little bit softer, but yesterday, a 10th straight day of gains. Lisa, over that period, we are up more than 40% on that single name.
Tesla shares are up 75% from hitting at 52-week lows back in April, 4% almost yesterday. Why? This is really the key question, right? What is the raging reason you can come up with for why Tesla ripped yesterday? People saying maybe what they reported on July 2nd about maybe company vehicle sales, maybe the idea of what they can do with robotic taxis. Very unclear to me. I'm not sure what you think of Bill Gross's explanation. Tesla is acting like a meme stock, sagging fundamentals, straight up price action. You could say that about NVIDIA as well. I mean, that's the thing. Yesterday, NVIDIA was up 3%. I think the bigger takeaway here is you haven't gotten a day where all of the Magnificent Seven stocks were acting in tandem. They're kind of acting like pillars that go back and forth, and people are kind of ping-ponging from one to the other, figuring out, is this going to be safer? Is this going to be safer? There is a feeling that maybe valuations are getting high, but it's unclear where, and from day to day it shifts. We can attempt to get back on top of the fundamentals a little bit later this morning. So yesterday was day one of testimony for Chairman Powell on Capitol Hill in front of the Senate. A little bit later this morning, Chairman Powell goes in front of the House. There was a standout quote yesterday. This one, I'm not going to be sending any signals about the timing of any future actions. And I think for a lot of us, we turned the volume down and moved on. But then he said something. Elevated inflation is not the only risk we face. And I think that is a very important line from the Fed chair.
He continued on yesterday to then lean into the labor market. The latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I wouldn't have said that until the last couple of readings. So he's starting to look at the timeline and trying to, I think, communicate without actually saying it. Yeah, we've seen the data. We see it cooling, and maybe we're prepared to move. Neil Dutta, though, immediately after he talked about labor is not a source of inflationary pressures, now sent this out. This has been true for months now, but nice to see Powell finally coming around. You know, I read the comments that Jay Powell and Neil Dutta's analysis yesterday, and my immediate thought was, this is kind of dovish. This is not really saying much, but this is kind of leaning into this idea of preparing the market for a September rate cut. The market action was interesting. The market seemed disappointed that there wasn't a greater kind of acceptance, that he didn't come out and say, September is on, guys. I mean, really, it was sort of interesting to me that you didn't see any kind of response in markets that it was a dovish message. What more did this market want? We've got CPI coming up on Thursday. They've got the opportunity to really outline plans at the meeting at the end of the month. They've got Jackson Hole in August. We talked about this yesterday. This Fed, led by this chairman, many other Feds by other chairmen, chairwomen as well, want a clear, clean sequencing. They want this perfectly teed up. But when he talks about more good data, what are we talking about? A month? 2 more months? 3? It seemed to be as though he was setting up September. A lot of people saying that in July at the meeting later this month, they're going to be talking about how the conditions are getting better for cutting rates. Anne-Marie talked about the idea of elevated inflation is not the only risk you had. You mentioned this too. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. These are dovish signals that signal that maybe employment is very much front and center. I think we all got that message from Neil Dutta. Mine had a different flavour to it. It was no blank Sherlock, something like that in my email. Thank you for that, Neil.
just yesterday. We all had two screens up, didn't we? We had Chairman Powell on one screen, we had Secretary Yellen on the other, and we all anticipated this. Secretary Yellen would be asked questions not just about the deficit, about the economy, maybe not even about financial regulation. It would be about the president's health. And that's exactly what happened in yesterday's testimony.
There was a tense exchange between her and New York Representative Mike Lawler. And he asked her, have you seen a deterioration of the president's health? Have you seen any implications to his cognitive health? And she said he's extremely effective in meetings, especially long meetings. She wouldn't give a date, though, about the last time she saw the president. And then Joyce Beatty, a Democratic congresswoman, was trying to get her name in there, saying, please, please stop. She's not a physician. Why should she be commenting on this? But Mike Lawler's point is you are a member of the cabinet. Has there been any discussions of the 25th Amendment? And that was an unequivocal no from Ms. Yellen.
This is going to go on and on and on, maybe for the next couple of months. Equity futures right now on the S&P 500 looks like this. I'm sure some of you are listening thinking maybe for the next few years. I mean, let's see what happens. Equity futures on the S&P 500 positive by 0.1%. It yields a little bit lower by 1 or 2 basis points on a 10-year, just short of 430 here at 427.63. The euro, just like yesterday, not doing much, still in and around 108 at 108.16. Coming up this hour, Brian Levitt of Invesco turning from optimistic to cautious on stocks. Greg Valliere of AGF Investments as President Biden looks to end a Democratic revolt. And Kathy Bostjancic of Nationwide ahead of day 2 of Fed Chair Jay Powell on Capitol Hill. We begin with our top story. The S&P 500 pushing to fresh record highs thanks to a 6-day winning streak. Brian Levitt of Invesco joining the chorus of warnings, writing this: for the first time in a year, we favour a more defensive posture in the near term. That does not mean that we eliminate equities from the portfolio, but rather shift towards higher quality. Brian joins us for more. Brian, good morning to you.
Good morning.
Before we get into what you're doing beneath the surface, this is a big change for you. Typically, you come on the programme, you sort of push all the bears aside and you say, I want to be part of this market. What's changed for you?
Well, the first thing I want to say is I still believe over the intermediate term we want to be in equities. I still come back to peak inflation, peak rates, peak tightening is favorable for equities over the intermediate term time period. What we're looking at is more of a tactical indicator that says, look, the global economy is growing below trend and it looks like things are starting to soften. So when you're below trend and things are weakening, you want to be more defensive in the portfolio. And some of that global weakness is being led by the United States. Things are slowing. It's not a recession call. It's not, something ominous is coming, but rather tactically, things are slowing down and we're still waiting on the Fed to respond.
That's the change, and I think that's the important distinction. We've been talking about global growth ex-US below trend for quite a while now. The new ingredients is the US slowing down.
US is slowing.
Something we've been talking about is at what point does someone like you become more concerned about what slowdown? That it's not just slowing,
right.
That it's slow.
That it's slow and that you may, in fact, have a recession. The good news is that we don't have a lot of excess in this economy. If you look at residential investment as a percent of GDP, if you look at inventory to sales ratios, this isn't an economy that's dealing with a lot of excess. We don't have businesses that are over-levered, banks that are sitting on piles of bad loans. And you see it in the corporate bond market. Corporate bond market isn't worried about this economy as of yet at all. Instead, what you're seeing is weakness, slowdown, which, by the way, is what the Federal Reserve wanted. It's here. The challenge is we've got a 5.25%, 5.5% Fed funds target, and yet the economy is slowing and inflation's in the comfort zone. So it's not a perfect backdrop for equities over the next few months.
You say go into quality, and I wonder how quality has changed, given the fact that some of the companies that are minting money have gained so much value over the past 12 months that they're the ones, and I'm thinking of Morgan Stanley, they're the ones that people are getting nervous about. Are you on board with that? This idea that some of the high flyers, I'm thinking of NVIDIA, I'm thinking of Microsoft, maybe have gotten over their skis?
Well, perhaps a little, but that doesn't mean that it doesn't go on. As the economy slows, investors are going to be looking for a spot for businesses that they think are going to continue to do okay in this environment. And so I think part of the challenge was our risk on call, which started last July, was a great one. But really, most of the broadening of the rally happened in a couple of months, right? Small, mid, did 20% in 2 months, November and December, on expectations of rate cuts. And then it's been all concentrated. So the risk on rally should have been broader. Then when you get to a more defensive spot, you tend to get more higher quality. So, they are perhaps a little bit elevated, but I think that's where investors camp out in a slowdown. That could persist ultimately, what ends up happening over the next couple of years is in a easing cycle with a normalization of the yield curve, you should broaden out. But in the near term, I think investors hunker down a bit and stay in those names.
So you're still a FOMO kind of guy, just with respect to NVIDIA and Microsoft, not necessarily with the rest of the broadening out. Is that correct?
Well, I'm a FOMO kind of guy over the next 3 to 5 years. Absolutely.
Okay.
Again,
so not in the near term.
Yeah, the headline might be it turns a little bit bearish from where we've been. I mean, we were full risk on since July. As things slow and we wait for easing, we get a little bit more defensive. But again, over the next 3 to 5 years, peak tightening, peak rates, peak inflation favor stocks.
Some of these words that people use, like becoming cautious or being more risk on, have different meanings depending on who the person is.
That's true.
And the idea of being cautious in the past has been going into long bonds, having more cash, and going into, say, dividend plays in the equity market. What's the new conservative position?
Yeah, so the way we think about it is, so if you take a 60-40 portfolio, when we're more risk on, that 40% fixed income is going to be far more credit. Credit tends to do well in more of a recovery, risk on type of environment. We would increase exposure to longer duration bonds, quality bonds. Quite frankly, you can get some very nice yields there these days. And I would be a little bit cautious about sitting out in money markets because those yields will ultimately be coming down. On the equity side, when you're more cautious, you reduce some of your exposure to international and you move into factors like quality and low volatility, and you reduce a little bit of your small cap exposure and go more large cap. So it's not wholesale changes. It's protecting some of the gains you've had in the portfolio and adding some protection in the fixed income market to a portfolio.
We had this debate yesterday about whether or not, as an investor, you can look through the noise of politics. Do you find potentially advantages ahead of November, opportunities, or do you think there's setbacks?
I look through the noise of politics. If you look back historically and you look at volatility in markets, it doesn't come because of elections. So if you look at October and November of election years, the only years that you see a meaningful increase in volatility are 2000 and 08. And that was clearly for other reasons than what was going on in politics. And if we have time for it, I'd like to tell investors 3 points on politics. The first one is, since 1957, when the S&P went live, every president has had a positive return over their administration, except W and Nixon, because their terms ended in bad recessions, or they left office in bad recessions. Number 2, Trump's portfolio, over Trump's term, S&P was up 60%. Where's Biden right now? 60%. So it didn't matter at all. And the third point I like to make is, if politics matter so much, then how did Obama and Reagan both have 200% advances in the market during their term? Right? They both had great starting points. You know, I could become president in a recession when the Fed's helping out and probably get a 200%.
Are you running? Because I think that's
Anne-Marie told me I have zero chance. So
you could head to the convention in August and make a challenge if you want. I think some people might be thinking about that. There have been changes, though, over the last decade. 2016, November 16, we were talking about investment in infrastructure, the Trump trade. 2020, you saw what happened when we started to see signs of a blue sweep and the prospect of more fiscal stimulus coming down the pike. There have been changes, and we're starting to wonder whether there's going to be consequences for the bond market. For two presidents, two leaders that don't seem to be willing to do anything about the deficit in a big way anytime soon.
Yeah. Well, I mean, with regards to the changes, you know, if we do go back to that 2016 moment, it was the hope, I think, from a lot of voters that Trump could unlock growth, could unlock value. And you had very much the same market leadership you had under Obama. So we didn't change the economic environment as a result of simply electing a new president. I mean, they basically get a couple of things done. They don't get to have their whole agenda play out. Now, with regards to rates, I heard this a little bit a week or two ago. You would know better than me, but right, there was a quick move up in the 10-year Treasury rate a handful of days ago. And people were asking me, is this the bond vigilantes? Are they finally here? There's nothing in the bond market that suggests the bond vigilantes are here. This is a bond market that's been moving very much on nominal growth expectations and expectations for the Fed. If the bond vigilantes were here, the U.S. dollar would not be as strong as it is. So no, it doesn't seem as if the bond market views this as a problem, and I've been saying for a long time, Jonathan, I don't think that this is going to be a problem. My clients think it's the biggest problem we have.
Yeah.
The U.S. debt level.
Your job is to provide therapy.
Well, I've been doing this for 25 years, and the debt's increased by 7 times. What was it, 5 trillion to 35 trillion, and yet rates are at 4% and the dollar's strong. So, you know, it's the Alfred E. Newman, what me worry at this point, right? I mean, we're a very wealthy country. Total household net worth is 150 trillion in this country compared to 35 trillion in debt. So I'm not overly concerned about this.
Brian, it's good to see you.
You too.
Brian Levitt of Invesco. Of Invesco for now and heading towards the convention in August. Maybe. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China's consumer prices eked out another small gain in June. Monthly CPI growth hovered near zero for a 5th month. That deflationary pressure is continuing, but the PBOC, as of now, is wary of lowering rates for fear of a weaker yuan. According to the National Bureau of Statistics, consumer promotions for the annual 618 Shopping Festival hurt the prices of entertainment-related goods, household appliances, and cars last month. Donald Trump is getting closer to announcing his vice presidential pick. During a campaign stop in Miami, Trump teased but did not officially announce that Florida Senator Marco Rubio could be his choice for a running mate. He stopped short of making an official announcement, but did say he was officially challenging President Biden to another debate, this time without moderators. Oracle shares dropped 3% yesterday after Elon Musk said his AI startup would rely less on its cloud technology. He was posting on X, and Musk said his firm would build a system to train AI models internally. The information had earlier reported that the companies ended talks on a potential $10 billion cloud deal where xAI would have rented cloud servers from Oracle. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, pressure building in the Democratic Party.
Donald Trump is on track, I think, to win this election and maybe win it by a landslide.
That conversation just around the corner, live from New York City this morning. Good morning. Live from a steamy New York, welcome to the program. Equity futures on the S&P positive by 0.1%. Yields a little bit lower. We're down 2 basis points on a 10-year, 427.63. Under surveillance this morning, pressure building in the Democratic Party.
Donald Trump is on track, I think, to win this election and maybe win it by a landslide and take with him the Senate and the House. The White House, in the time since that disastrous debate, I think has done nothing to really demonstrate that they have a plan to win this election.
It's the latest. Divisions growing among Democrats over President Joe Biden's re-election bid. Senator Michael Bennet becoming the first Senate Democrat to cast doubt on Biden's chances publicly. Bennet stopping short of calling on Biden to bow out, but 9 House Democrats have now called on the president to step down from the race. Joining us to discuss is Greg Valliere of AGF Investments. Greg, what can the president do to stop the revolt?
Well, I guess he'll have to have good press conferences starting tomorrow. But, John, I got to tell you, I think more and more people, at least that I talk to, say he can't serve for 4.5 more years. I don't know anybody who thinks he can serve for 4.5 years if he wins re-election. The other point I would make is that can Joe Biden go from now until November 5th without another stumble, without another gaffe? I sure doubt it. And I think if Biden does make another gaffe or have another disastrous, press conference, he's out. So either way, I'm not high on his prospects. I think it's unlikely that he will be on the ticket on November 5.
Greg, we have Mikey Sherrill yesterday, the representative, coming out saying Biden should step aside. But who is it going to take to have to say that for the president to actually take it under consideration?
I think probably people in his family, whether it's Hunter or Jill or people very close to him, would have to do this. Or we'd have to see polls over the next few days that show a significant deterioration. Or if he makes a gaffe tomorrow at the press conference. So there are a lot of factors. But again, I'm not high on Biden's chances. I think that between now and the election, he'll have more problems.
So what's the timeline? You don't think he's going to be on the ticket. What's the timeline of him stepping aside?
I have no idea. It could be September. It could be later. It could be next week. I think that it all depends on events. He's obviously angry and feisty and is going to fight this and see if he can hang on. And I think he's had a pretty good 48 hours. I think a lot of Democrats are resigned to him winning. But Senator Bennett of Colorado did make a good point, and he used the L word being landslide. And I do think that people in the Democratic Party are now worried that they're going to lose the House and the Senate and the White House.
When you say you think it is highly unlikely that Joe Biden will be on the ticket in November, the path to how he gets off the ticket and who comes on is actually incredibly important to understanding what the chances are, how this sort of skews the election results at the end of the day. At what point do you see some sort of coalition of Democrats getting together and taking action sooner versus just letting this play out in a series of gaffes that is a drip, drip, drip feed until November?
Yeah, it's a terrible choice, Lisa. Nothing the party is real happy about. I mean, I do think that he could hang on for a few more weeks, and you have to admire the fact that he's fighting for his political life, and he's had a history of making comebacks. But this one, to me, is too tough to overcome.
Meanwhile, you do have the issue of what Donald Trump is talking about, which is basically going directly after Kamala Harris last night at the convention or at the speech that he was giving. And there's this question about whether there's a shadow race going on, essentially, whether essentially Kamala Harris is the presumptive nominee for a lot of people, and whether that's actually becoming increasingly explicit, even in what we're hearing from Donald Trump.
I think it's virtually certain that she will have to be the nominee. I'd be shocked if anybody else mounted a serious challenge. I think the party is thinking that she is fairly talented as a politician and could be underrated. So no, it's going to have to be her. I can't see any other. We're down to only 3 people who could be president. One of them is her.
Greg, I want to return to the pressure point, where the pressure comes from. On the donors, the president's given us the impression that he doesn't really care what they think. On the party officials, he's come out swinging at anyone who is testing him. And then when it comes to the polls, you saw in the interview last Friday, he thinks this is a coin toss, coin flip. He doesn't think this is close, as far apart as maybe some of these polls suggest. So, Greg, I'm just wondering where it comes from in the polls, because based on what we've heard from him, he doesn't believe them.
That's a good point, John. With the exception of the New York Times poll, which is showing Trump ahead by quite a bit, all the other polls, to my shock, are close. I mean, after that disastrous debate, I wouldn't have been shocked if Biden was down by 8, 10, 12 points, but he's not. He's down maybe by 2 or 3 or 4 points. That shows that maybe most Americans have made up their minds. Maybe most Americans aren't paying attention. They didn't pay attention to the guilty verdicts in New York. Maybe they didn't pay much attention to the debate. So there still is a path, a very narrow path for Biden. But the one thing I can't get my arms around is the Electoral College. I just cannot see Joe Biden coming to 270 without some big upsets in states like Wisconsin.
Greg, it's good to hear from you. Greg Valliere of AGF Investments on the prospects for President Biden, not just in November, getting to November, winning in November, but ultimately governing for another 4.5 years.
Greg makes a point there, though, that maybe the electorate is missing it. I actually view this differently. Maybe it's the Democratic elite that is missing it. Biden's age has been showing up in polls for over a year. And the issue is the fact that most Americans care about the economy and they care about immigration. And when you ask them who do they trust on those issues, it continuously is the former president, Donald Trump. So the electorate, I think, has been there. This debate has woken everyone else up for it because you couldn't ignore it. It was right in front of your face.
Yeah, I think within what you've just said is quite important. When you listen to Democratic officials, those that have come out against the sitting president, they'll talk about his age a lot, as if that is the only reason that the sitting president lags in some of the polls. And they don't talk about the substance, the policy, some of the issues in this country that haven't been addressed over the last 3.5 years.
It's true, which is why it's so surprising to see some of the progressive wing come out and back President Biden to become the nominee, considering some of the dissonance between those two groups. That said, that was all baked in. The wake-up call was very much just his demeanor, his carriage, his age, his mental fitness, and that really is what a lot of people are focusing on now.
And apparently a much bigger wake-up call for people within the party and not the general electorate. Coming up on the programme, President Joe Biden looking to return to form and reassure NATO allies. A big week for the president coming right up. It's the price action this morning. Firmer on the S&P by 0.1%, on the Nasdaq up by a third. Look out Tesla, new price target over at Goldman, 248 from 175. I think a lot of people playing catch up. We've had a 40% move over 10 trading days. Phenomenal.
I wonder why, though. Again, is it because of options trading behind the scenes? Is it because of fundamental beliefs that they're closer to coming up with a robo-taxi or some sort of vehicle? It is unclear to me, and I think that's the reason why Bill Gross was talking about it being a meme stock.
A meme stock, the valuation versus, say, the fundamentals. It's hard to call it a growth company when there hasn't been growth, right? And I think that's the struggle we've all got with Tesla at the moment. The carrot over the stock has been this robo-taxi announcement in April that we've all had circled on the calendar since early April. That date is in early August, so look out for that, I guess. In the bond market, yields 462 on a 2-year, 10-year 427.44. Lots of debt coming to the market. Yesterday we had, what do we have, a 3-year note? Went pretty well, Lisa.
Yeah,
Later on today, $39 billion of 10-year notes coming to the Treasury.
Yesterday actually went very well. And what people say is that seasonally this is a good time, a strong time to sell debt for the U.S. government. I love, though, what we just heard from Mr. Levitt when he came on and said, I can't find the bond vigilantes. If they're there, well, I'm not finding them because they're not showing up in any kind of meaningful way. Any kind of hiccups in the bond yield can be directly attached to another narrative, in particular the economy. And that, I think, is what we're seeing in terms of some of the reception for these bond auctions.
They're not in France either. Yields are lower by 7 or 8 basis points. Switch at the board and get to Europe. Things are looking a little bit better. It's been difficult. I know it's been difficult for a while, but French bond yields down about 7 or 8 basis points to 3.17. That's the story in France. Under surveillance this morning, President Joe Biden losing the support of another Democratic lawmaker in the House. Mikey Sherrill of New Jersey calling on Biden to end his re-election bid, and Senator Michael Bennet of Colorado telling CNN that Trump is on track to win and sweep Congress, but did not explicitly call on Biden to bow out. The list is getting longer and longer.
The list is getting longer, but Terry Haynes makes this point. Party leaders pressing Biden to go could move the needle. Backbenchers do not. So the party leaders, or potentially his family, could be the Lord Almighty Biden's looking for. Everyone else at this point is just noise. But at some point, do those individuals, does it become so big, this list, that it pushes potentially the Hakeem Jeffries, the Schumers, the Pelosi's, maybe Dr. Joe Biden, to telling him, okay, you have to step aside?
Everyone's got to manage their own career risk. And you see that happening right now on Capitol Hill. There is a reluctance to come out on the record and say what they're saying privately, which is why, what's the number now? 9, 10, something like that? It's not a long list of people in the grand scheme of things. It's getting longer. But you know it's much, much longer when you talk about what's being said privately versus what's being said publicly.
And you're not seeing that sort of groundswell continue in that kind of scope. Yesterday, we didn't see that many people come out versus the day before. The Washington Post had a story about how in some ways Hill Democrats are divided and many of them are just coalescing around Biden. This is sort of the key question. There hasn't been a real challenge to Biden, in part because of career risk for their potentially being just extricated from the party in some capacity. And you wonder how much that's really holding a lot of people back in a material way.
When you're explaining in politics, you're losing. Every day they're explaining that he can govern every single day. That does not set you up well for not just the next 4 years, but and winning in November. Cook Political Report yesterday made 6 changes. These are the 3 biggest ones. Arizona, Georgia, Nevada were toss-ups, and now they're lean R. These are states that Biden should be very competitive in. And right now, what they're saying is these are going to go red.
This is why that career risk cuts both ways. That if you lose in a landslide in November and you didn't say anything, then I think you're equally in as much trouble if you did and he wins. In fact, it might even be worse.
Well, this is why Greg Valliere's point is really interesting and why we both were struggling to the path of exactly how Joe Biden gets off the ballot. Because is it going to be pressure for the inside group? If, let's say, Thursday is a really rough press conference, is there basically a coalition of Democratic senators, not House representatives, that come out and say, we don't think you actually have it anymore and we don't back you in the same kind of way? Or is there an inner circle that kind of forces him out? These are some of the questions that people have, and it really hinges on just what that threshold is areas in terms of his performance.
The fallout of that debate debacle continues in Washington, D.C. and across this nation. On Capitol Hill, once again, is Fed Chair Jay Powell set for day 2 of testimony. Powell telling a Senate panel yesterday that risks to the labour market are rising and adding that officials are close to agreeing a new term for bank regulation. Powell testifying before the House Financial Services Committee at 10 a.m. Eastern Time. Anything that was missing yesterday for you that you think needs to be addressed later this morning?
I thought it was interesting that in his actual prepared remarks, he talked about the Fed independence in this really aggressive way that I thought was kind of interesting. It was a new type of reassertion of that, which raised questions about, what kind of political threats he's under. I think it would be interesting for people to understand exactly what data he's looking for to really gain confidence, although he came out yesterday and said, frankly, he's not going to give any indication. This is not forward guidance. I'm going to say as little as I possibly can. I think it's going to be tricky for them to get anything out of him, but where I would press him is both on the politics of the moment, given some of the proposals, given some of the tariffs and some of the immigration issues, and understanding where they are now and understanding the labor market and just how much it's cooling and what's driving that. Those are some of the things I think could make a material difference.
There is the upper chamber, the Senate, and the lower chamber, the House. And I think sometimes people expect a little bit more substance from the upper chamber. The lower chamber of the House, I think you're going to get a little bit more theater on the politics. But Powell didn't bite yesterday. He was asked from Senator Kennedy to talk about Bidenomics, is not going to comment on it. I agree with you. These kind of policy changes, immigration, tariffs, when you see inflation, is this due to fiscal spending? He's not going to make comments on it. But it's important to understand what 2025 looks like.
I was surprised by how much they talked about financial regulation yesterday.
Yeah, especially because the Chevron doctrine kind of took it off the table to a large degree. So there's a real question about the relevance of his control over it anyway.
Look for a repeat of that a little bit later, maybe. Let's talk about this one. President Joe Biden and NATO pledging 5 more Patriot air defense systems to Ukraine. The assistance coming as Biden looks to reassure allies he's fit for the job in a speech marking the 75th anniversary of the alliance. The NATO summit continues today with Biden preparing for his first bilateral meeting with new British Prime Minister Keir Starmer. Bloomberg's Piotr Skolimowski joins us now for more. Piotr, let's talk about what's on the table today and what the reaction was to that address just yesterday.
Hi. So indeed, what we heard yesterday was a pledge of 5 Patriot missiles and other air defense system, but also short-range systems. We also heard that Ukraine will be delivered F-16s finally, which obviously has been pledged. A lot of the pledges that we heard yesterday, although Biden called them historic, they really warm over things that were already promised months ago. What we're going to see today is obviously this is the moment where the summit really kicks off. And there are a lot of bilateral meetings, and obviously Biden's health is front and center of the discussions between the leaders, and also people who are attending the summit. He's going to host a dinner today with heads of states from NATO member states, and it's going to be at 8. So obviously the crucial time at which he actually should be resting. So that will be a moment where people will be really focusing on. And so far, obviously, we also heard yesterday from President Zelensky. He gave a very feisty speech yesterday, not actually mentioning election as such, but he said that NATO summit or NATO leaders, and especially U.S. and the rest of the world, are waiting for November. And instead of waiting for November, they should actually move on and try to help Ukraine right now, provide more help, but also provide a path or commitment that Ukraine will join NATO at some point. He's not going to get an invitation. Obviously, what we're hearing is that from the people around him is that he's not very happy about that, of course. So more of this will continue today.
Also behind the scenes, I know that a potential Trump 2.0 presidency is being discussed. The issue is, can you give us a sense of what people are saying on the ground? Because Trump's rhetoric on NATO has been very hot. But when you look at the 4 years he governed, we had javelins to Ukraine, and we had more tanks to the eastern flank. So actually, the U.S. upped their commitment to the alliance. Is that not correct?
Indeed. So obviously, part of it is the rhetoric, especially coming from Eastern European countries. that they're trying to say, well, actually, rhetoric is one thing, and Biden and Trump has actually said he has this plan, he wants to end the war. But we heard, for example, from Latvia's foreign minister yesterday. She was in the studio and she was asked about potential Trump president, and she said she's not worried. I mean, she said we worked with President Trump when he was in office. There was no sense of sort of lack of commitment to NATO, and also, as she pointed out, compared to the time when he was in office, NATO is spending much more, and that's sort of the refrain that we keep hearing all the time. 23 members are already spending above the 2% target. Some are trying to get even above that, especially from Eastern Europe. They are spending even, as Poland, for example, 4% of GDP on defense. So at least on the level of rhetoric, especially Eastern European countries, which are most concerned, they're pointing out there's a huge gap between what Trump has been saying on NATO and what he has done while he was in office. So they seem to be more confident than we're hearing overall.
Piotr, it strikes me that as NATO members are meeting and talking about the threat of Russia and how to isolate Vladimir Putin just had a bear hug with Indian Prime Minister Narendra Modi. He just visited with Xi Jinping, talked about their increasing alliance. This doesn't seem like an isolated leader. How much is that looming large over a lot of the NATO members this week?
Of course it does. It's a big concern for NATO members, and Putin has really tried to kind of drive the wedge. And he was actually helped by one of the members of the NATO alliance who actually visited him just days before the NATO summit, and they talked and they shook hands. So Putin has done quite a lot going into this summit just to project the image of the guy of the leader who's not alienated at all. As you said, he met India's prime minister. He also met others, and clearly he's coming into that summit strengthened, and also sort of being helped by some of the members who are here. Obviously, Viktor Orban is one of the people who is raising certain concerns with EU leaders at this summit. He arrived after those meetings. He actually met Erdogan yesterday, and he's the one who's trying to push the idea of a peace plan, whatever that peace plan is, because we're not really sure about the details of it. So this indeed it's a lot of wins for Putin just coming into that summit.
Piotr, thanks for the update, sir. Bloomberg's Piotr Skolomoski. Thank you. And coming up on Friday, AMH sitting down with the NATO Secretary General Jens Stoltenberg. Look out for that on Friday morning, following a must-watch news conference with President Biden on Thursday. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Microsoft and Apple have given up the chance to be observers on OpenAI's board. It comes as global antitrust regulators step up scrutiny of big tech's influence on AI. Microsoft, which has invested $13 billion in the creator of ChatGPT, sent a letter to the startup announcing its withdrawal from the board. And HSBC is reshaping its investment bank, making it look a lot more like its U.S. rivals. The bank will combine several of its industry coverage groups to help with efficiency, according to people familiar. It's a move that Citi also made in recent years. Lenders are shaking up their investment banking divisions to prepare for a world of falling rates that eat into profits. And a penthouse in New York City has sold for $135 million. That is the most expensive home bought in Manhattan since January 2022. It's a 5-story apartment. It sits atop the historic Crown Building on Fifth Ave, now part of the Aman. It was sold as an unfinished space that the buyer is now responsible for building out, a spokesperson for the developer said. The price breaks down to nearly $10,000 per square foot. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes. I love that you can drop 100 mil plus on a property and you've got to finish it.
Yeah, well, it's 5 stories. Did you see the property?
I've seen it, yeah.
I spent some time with it.
I looked at it this morning.
Did you see the wraparound terrace at the very top?
You know, it's really sad.
What?
The chances that no one lives in it after paying that much for it.
I was wondering, is this going to be some sort of ambassador's residence that's never going to come?
I don't know.
I know.
I think that's just how you park $135 million these days.
I wouldn't know.
Yeah, neither would I. Up next on the programme, Fed Chair Jay Powell keeping September on the table.
The labor market appears to be fully back in balance. The most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago.
That was day one yesterday. Day two coming up later on this morning. From New York, this is Bloomberg. Stocks are positive here by 0.1% on the S&P 500. If you check out the bond market, yields are a little bit lower, down 2 basis points, 427 on 10s, ahead of 10-year supply a little bit later on this afternoon. Under surveillance this morning, Fed Chair Jay Powell keeping September on the table.
The labor market appears to be fully back in balance. The most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market.
Here's the latest for day two. Fed Chair Jay Powell heading back to Capitol Hill today. Powell is set to testify in front of the House after telling a Senate panel that risks are rising for the employment half of the Fed's dual mandate. Kathy Bostjancic of Nationwide Mutual Insurance joins us now for more. Kathy, what didn't you hear on day one that you'd like to hear on day two?
Good morning, John. Well, it would have been great to hear a more definitive guidance from Chairman Powell, but I didn't really expect that. He's, holding his cards close to his vest in a sense. There's CPI data out on Thursday, so you can't really signal that, rate cuts are coming, maybe in September, which is our baseline view. Until they get at least one more good inflation report. I did think he was pretty forthcoming, though, on the labor market. There's a lot more recognition that things are fraying on the edges there and that we have a more balanced outlook now, right? It's not just concerned all just on inflation right now.
Is that how you'd describe it? Just fraying of the edges of this labor market, or is it something worse?
Well, we're seeing signs of fraying. We do think some further slowing, maybe some cracks start to emerge. We don't, necessarily think there's a recession on the horizon. We think that, that having a soft landing is quite possible at this point, but it really is contingent on the Fed getting going here and starting to cut rates. There are pressures, throughout the economy, not just the labor market, but many, households that rely on variable rates, right, for borrowing, and also some of the, corporations, small and medium-sized enterprises, really feeling the weight of these high interest rates.
Kathy, I agree with you. I think that Jay Powell was actually quite forthcoming when it came to his view of the labor market, and it confirmed what market participants have been saying for quite a while, saying elevated inflation is not the only risk we have. Reducing policy restraint too little or too late could unduly weaken economic activity and employment. So why is it, Kathy, that markets seem disappointed by what they heard and didn't increase the chances of a September rate cut? In fact, if anything, the chances went down, and there seemed to be disappointment that he didn't come out and just say September's on.
Yeah, I did notice that as well yesterday. I think that's markets just being markets and sort of hedging a little bit. I was watching the odds. It had gotten up over 3/4 of a percent odds that they would cut in September, and it backed off a little bit. I think really, we're all waiting for the CPI data on Thursday. And listen, if it surprises to the upside, then even our call in September doesn't look all that good. Assuming we get another good benign reading, I think that gives them green light. But there's no doubt, there's some slowing in the labor market. And you look at the composition, even payrolls, which people say, oh, employment's still strong. But as rightly pointed out, I was quite impressed in the Senate questions. A few of the senators understood that 3/4 of the gain in payrolls on Friday were really two categories, and both could be related to government. So the private sector is starting to slow down, and I think it's on their radar screen. I think they just need the inflation data to cooperate.
I'm wondering about Thursday, when we get that CPI data, how much you're going to see sort of a binary response in markets, whether it goes to 0 for September or 25% or whether it goes to 100%. If we get what's expected in terms of CPI coming down to 0.2% with just stripping out energy and food, do you think that that green light September, regardless of all of the concerns about some of the base effects and things of that nature?
Oh, yeah, I the base effects are there, but I think they're squarely, looking at 3-month annualized rates, the month to month. And he said, we just need another good monthly, reading. They're going to look beyond the base effect, and the markets are too, right? If you look at the TIPS market or, just the bond market's expectations of Fed easing, it is really the run rate, the current run rate that matters most.
When it comes to what we heard from lawmakers yesterday, potentially hear more about this today, it did get a little bit political. Senator Kramer said that rates shouldn't move in either direction before the election because of the optics for that. How much do you think the Fed is taking all of this on board?
I think, very little. I think if it's there, they try to put it out of their mind. I mean, I really do take Chairman Powell at his word that this is not entering the decision-making process here. They're just looking at the macro fundamentals, doing their best. And you could argue if they don't cut rates or move before before the November elections, they actually then are indeed influenced by that. So I think that they'll just keep their eye on the data here.
To Lisa's point earlier, though, she said she would love to hear more about what policy would mean for the Fed, things like tariffs and immigration. At some point, does this Fed need to start talking more openly about that, given the fact that there's some people come on this program saying that could mean a hike in 2025?
They're not going to, Chairman Powell is not going to do that. Fed officials won't. It's just premature at this point. We don't know, as Powell said, to make conjecture about campaign promises right now. You have to see what plays out, what actually gets passed, and then they'll react. They have to be reactive, and otherwise they do, risk sounding, political at this point. Obviously, many of them internally will have their own views of, tariffs or tax policy changes could impact things, but they'll really wait and see and deliberate on what they get from fiscal policy, not what what the campaigns are suggesting.
You have a bit more space to develop those views publicly, unlike Chairman Powell, Kathy, and perhaps we can do that right now. If you do come forward with the tariffs that the former president is suggesting, there are some who think that maybe the Federal Reserve commences hiking in 2025. Have you developed any views, any firm views around that particular topic?
We're also kind of in a wait and see mode, to be honest with you, because there is so many variables, right? What actually gets, what's rhetoric and what's reality. There are differences. But clearly, if you have large tariffs, clearly that could be inflationary and impact the consumer in a negative way. And, does the Fed react with higher interest rates? Perhaps, but maybe it's also a tax on the economy and slows things down. So we just don't know. And it depends on the macro backdrop. And if things are slowing down prior to that, right before the implementation, the Fed could be cutting rates regardless. So there's just a lot of uncertainty between now and then.
Flying blind into 25, it's a theme on this programme. Kathy, thank you. Kathy Bostjancic there of Nationwide. Heard this a few times, that maybe in a short term it's inflationary, but in the longer term it's going to hurt growth.
If you think about what inflation is, it's the rate of the price increase over time. If you have some sort of sudden change in policy of where goods are coming from, one argument is it will be a one-time price hike. So prices will go up, people will buy fewer of them, and that will depress growth, and inflation won't keep going at that same pace because it won't just sort of be every year up by that amount. That's one argument for why it might not be inflationary in a way that the Fed would have to counter. I do want to hear, though, what people's understanding and the Fed's understanding of what the effect of immigration has been on the labor market. Because it's one thing to say we don't understand what's going to happen. It's another thing to say we have no clue what's happening right now. And that's what I want some clarity on, how they interpret some of the guidance that we've been hearing.
So Adam Posen of the Peterson Institute, he touched on both. and ultimately where he lands is hikes in 2025. And he was talking about the stagflationary effect of the changes to immigration policy that we might expect coming next year.
Given the fact that the incoming workers for this economy have really upheld it and allowed inflation to not go too far, of course, there is this question of if it allows prices to remain stable, you have to wonder what that means for the effect on wages of people who exist in the nation. I mean, there's just a lot of uncertainties. I just think that we should be, I want to hear more about how the Fed is unpacking some of this and how they're trying to think about it rather than just what they think future policies are, which they can't get their head around and they could easily just punt.
I think they're really, really struggling to navigate policy in Washington right now.
I would agree.
And don't want to step on any landmines going into November. And you could sense that yesterday.
Yeah, I want to just...
I know, you want to keep pushing.
Yeah.
And I do too. We'll keep pushing. Up next on the programme, Dan Skelly of Morgan Stanley, Democratic Congressman Jonathan Jackson of Illinois, Drew Pettit of Citi, and Lisa Coleman of JPMorgan Asset Management. All of that on a second hour of Bloomberg Surveillance. That's up next.
As we look ahead to the second half of the year, maybe we have less negative surprises from rates, maybe even positive as we head into rate cuts.
The data is very clear, and it's sending a green light to the Fed that they actually can adjust policies.
They're going to do what's right for the economy. And if that requires a larger cut to start off the process, they'll do it.
That financial condition easiness, it allows the Fed to be patient, but it could turn on a dime.
Our base case remains that December is going to be the first cut, but the door is definitely wide open.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Your equity market at all-time highs. Coming into Wednesday, equity futures positive by 0.1% on the S&P 500. Let's get to the day ahead. It looks a little something like this with Chairman Powell speaking at 10 a.m. Eastern Time. We also get some debt supply, which Lisa's very, very interested in. The 10-year auction, Lisa, a little bit later on this afternoon.
Yeah, $39 billion of bonds. Although I have to say, it was a bit of a buzzkill. Yesterday, a 3-year auction came out, and it was actually really positive. It came out very well. I like what we heard from David Levitt, this idea that he can't find the bond vigilantes. If they're worried about the debt, where are they? Because right now, this has been something that's been going on for quite a long time. And he doesn't really see the kind of pushback that can't also be connected to economic types of news.
Just because there's not much price movement doesn't mean there's no tension. And we know there's some tension in the tug of war right now between the political considerations and the weakening economic data. It's like two opposing forces. Coming off the back of that debate, we started to consider Trump Volume 2, sell bonds. And then we started to consider weaker economic data, buy bonds. I still think there's some tension going through the summer on those two issues.
There's a tension between the people who have to make a trade on it in the market and the people who understand that the worry about the deficit will actually keep it a little bit in check. We'll keep spending a little bit in check. If you don't worry about it, then you get profligate spending, and then you get, say, I don't know, a Liz Truss moment. So that is the fear that people have baked in at a time when there isn't much else that's kind of driving markets. Like, yes, we got a 36th record high, but it was limping and wheezing there. It was just a couple of the mainstays.
It was small.
Yeah, I mean, it really doesn't feel like some kind of rip-roaring direction or feeling of confidence right now.
We've squeezed out 6 days of gains on the S&P 500. We can confront the economic data, more of it later this week, CPI on Thursday. Can try and get your hands around earnings. We'll get bank earnings on Friday. It's much more difficult to speculate on the future of politics. Never mind discussing the outcome of November. We still don't know for sure who the two candidates will be facing off by the time we get there.
And you kind of heard that yesterday, Trump giving this rally. He started talking about the Biden-Harris ticket. As much as he was bashing Joe Biden, he also started to bash Kamala Harris because there is potential that it could be her at the top of the ticket. And Washington Post has some reporting that the Trump campaign prefers it to be Biden, but they're also going to prepare for Kamala Harris. I'm going to be going down to D.C. for NATO. Biden's going to give his press conference tomorrow, and a European diplomat had said, it's a pity that we can't talk about substance as much, or a lot of the optics isn't about substance, and everyone is just hanging on every word and move the president makes because they want to see what this means for November.
I think a lot of people say that it's a pity that we can't talk about substance in a broader level. And I wonder how much markets are just sort of, benumbed to the drama, and it becomes personal intrigue. And a lot of people say, OK, what's going to happen, et cetera. It makes for good kind of, gossip, but not necessarily anything that changes people's markets' view until it doesn't. And I guess that's sort of what we keep hearing from everybody. And if it does eventually, you can't get ahead of that freight train.
That felt very real, very personal. Because I feel the same way. We'd all love to talk about substance down in Washington, D.C., but that's not going to happen anytime soon. You know what's going to happen in that news conference on Thursday? Should be about NATO. Should be about the wars that many countries are engaged in right now around the world. What's happening in Gaza, what's happening in Ukraine, what that's going to be about repeatedly throughout that whole news conference. And I imagine you'll be in the room. We're going to hear it again and again and again. Reporters will just want to be talking about his health and the prospects that he's not on the ticket come November.
Which he will have to be very prepared for. And this is really the issue, is how much oxygen does that suck out of the room? And we can have a discussion about whether that's a problem just in general for the U.S. leadership, et cetera, et cetera. It doesn't seem to matter, though, for policy. And we talked to Greg Valliere. He's saying he's not going to be on the ticket. OK, well, what's the path to get there? I mean, there was a Washington Post story about how Democrats are kind of coalescing around him because what is their option? You talk about career risk. It becomes a sort of noise in the background of frustration. And it's the reason why a lot of people come on the show and say they're tuning it out.
I can promise you this, there's going to be a lot more noise. And it's going to get harder to tune out as the week grows older, OK? Here are the scores right now in financial markets. On the S&P 500, positive by 0.1%. In the bond market, ahead of that supply, yields lower, bonds rallying, 426.85 on a US 10-year. The euro a little bit stronger. European assets doing OK today. Equities bouncing back, bonds firmer, yields lower in France. The euro stronger to 108.22. Coming up this hour, we'll catch up with Morgan Stanley's Dan Skelly with stocks on a 6-day winning streak. We'll speak to the Congressman Jonathan Jackson amid more calls for President Biden to drop out, and JPMorgan's Lisa Coleman on why she's buying riskier bank bonds. We begin with our top story, the S&P 500 at all-time highs, powered by big gains in big tech. Dan Skelly and the team over at Morgan Stanley writing this. Wall Street has tilted towards the tech sector to a historic degree, raising the stakes should the AI-fueled rally falter. Valuations are stretched, while earnings growth is poised to slow from here. Dan joins us around the table. Dan, it's been too long. It's good to see you.
Great to see you, Jonathan.
Is this rally going to broaden out, and what gets us there?
We think it does. So a couple of key catalysts, right? First, we still think that the Fed is going to cut later this year. Ellen has stuck with her 3 cuts call, and we think that's going to happen amid a still positive economy. So we think that definitely helps boost sentiment for some of the more value and cyclical sectors. Second, and a lot of your guests have been speaking about this, so it's not necessarily the biggest unknown, but the spread between tech earnings and Magnificent Seven earnings and the rest of the market starts to compress as the year goes on. So you're going to see that earnings revision story start to improve for the everything else part of the market.
Within the everything house, are there parts of the everything house that you're more constructive on specifically? Is it the financials, the banks? What is it?
Financials are starting to act a lot better. You heard some positive regulatory rumors recently. We still think there's a capital market cycle coming as the Fed does cut. We've been in a 2-year down cycle in M&A, so there's some pent-up demand there. So financials are definitely part of our preferred list. Industrials, right? We're still seeing massive spending going on from the fiscal initiatives. And this is an area, frankly, that intersects a lot of technology and a lot of structural trends towards powering AI and technology. So that's another preferred sector.
So you could make a bullish argument for what you just said, and you could make a bearish argument for what you just said. If big tech isn't going to power the gains, well, the gains kind of wouldn't have happened, right? Your shop was talking about how NVIDIA has accounted for about 30% of the gain year to date on S&P. So are you looking for index level S&P to actually fall as people shift away from big tech, even as you do see all of these opportunities in a broadening out under the hood?
It's such a great point, Lisa, and it's an important idea to think about from a broader portfolio perspective. In our view, we see more broadening out. It's hard in our view to get a huge correction if the earnings are still positive for technology. So we're talking about relative revision strength changing on the margin. We're not talking about a collapse in earnings for technology. We still don't know what the effect of AI is. The market has been in this phase of suspending disbelief for some time in terms of ROI and adoption, productivity gains. That story is not going to play out, Lisa, for like another year or 2 years. And so we see more intrasector, more intramarket rotation than a bigger sell-off from tech.
This is what I find fascinating. And Bill Gross was talking about Tesla acting like a meme stock. And I know that Tesla is its own ball of wax. But there's this question of how much you could actually see some of the negative feelings or the fear that people have around some of the tech valuations translate into any kind of pullback. I mean, hasn't that been the big challenge, given the fact that valuations have been concerning for a while, especially given the questions about AI, but it hasn't materialized into losses?
No doubt. And let's also face reality, which is that you've seen this optionality in AI, this massive fervor around what does it do for the economy and for all these different structural productivity trends. But at the same time, let's not forget that while that's been the sword, the offense, big tech has also had the shield of strong balance sheets. And so in a world where narratives around interest rates have shifted dramatically this year, first very scared about inflation, now a little bit more tepid, the idea of having net cash balance sheets has been a strong defensive haven for this group as well.
When it comes to these changes you see in consumer trends that you want to get ahead of, what exactly are they? What are these names that you think can outperform towards the end of the year?
So, Anne-Marie, you've seen a massive divergence in the consumer in recent months, and this played out in first quarter earnings. The restaurants, the airlines have all shown this divergence between high income and low income. And you're seeing more normalization post-COVID as those stimulus checks have really been exhausted. So to your point, what we're trying to think of is there's been this kind of extreme crowding in the high end. We're thinking as rates do come down later this year, you're going to see some relief for those consumers who are more debt laden. And so we think possibly getting a little bit more aggressive on lower end consumers is an idea to play later this year.
So is the biggest risk, though, the potential that there is potentially a recession?
So in our opinion, it's hard to imagine a recession today. Ellen Zettner, as background, has been in the soft landing camp for 2 years. I have to give hats off to Ellen. And what I would argue here is you're seeing this two-track economy. A lot of folks are trying to put today's inputs and today's data into a very clean and smooth historical model. And they're trying to bucket it as either the hard landing or the soft landing. And what I've argued for some time is there's no known flight path for the situation you're dealing with today. Post-COVID, there's so much nuance. There's so many one-offs going on that we frankly have never seen before that it's resulting in this two-track economy. So for the asset owners, the folks who've benefited from portfolio gains and from residential price appreciation, they have so much concentrated wealth effect and frankly more power than they've ever had in 20 years that their strength is still offsetting some of the degradation in the other track of the economy that is seeing real pain from high interest rates. So on net, we think the outcome is it's hard for the slowdown in the second track mathematically to hurt the average, to cause a recession, when 70% of overall spending is coming from the first track.
Do you think that spread can close, though? Because that's a very different conclusion.
So we think it certainly can, but rates are a big part of it. Rates have become the dividing line in terms of behavior and consumption. And look, the other thing to think about is the labor market, right? Like a lot of people are starting to get concerned about the cooling in labor. Powell talked about this a lot in his testimony yesterday. He's starting to reintroduce two-way risk. Inflation is certainly still a goal, but he's starting to reintroduce the idea of the other part of the mandate in terms of employment. We would argue that a lot of the normalization post-COVID has happened. The quit rate, as one example, has certainly normalized to a more realistic level than we were seeing 2 or 3 years ago.
How many questions are you getting about politics and the election right now from clients?
Basically on the hour. So it's certainly flooding.
Is it like 99% of the conversation at the moment?
Among the wealth management channel in particular, it is at a fever pitch, and we don't expect the noise to tune down anytime soon.
You said noise. Do you think it's just noise?
So it's not noise in the sense that you have to have a view, and you have to have some type of baseline of expectations. So, look, I'll just say this. I think this is one of those very rare instances in American history, and as a history geek, 150 years to be exact, where you're seeing the incumbent face off against the candidate he actually defeated in the last election. So Grover Cleveland, 1892, is the last time this happened. The nuance here is that you've seen both of these gentlemen in office before, and frankly, love them or hate them, and there's a wide spectrum of reactions on either side, the markets and the economy behave fairly well under Trump and have done the same under Biden. So I think there's this massive kind of pre-election and candidacy, uncertainty, and all these different noise that you're seeing at the moment. But the reality is, I don't think that it's going to really offset or take off track a lot of the positives out there either. And I think the biggest surprise is that the election just ends up being a big nothing burger for the market.
Dan Skelly at Morgan Stanley with quite a headline there. Dan, thank you. Lisa's hoping, anyway. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A court victory for Elon Musk. The billionaire defeated one of the lawsuits filed against him after he bought Twitter and fired thousands of employees. The suit alleged that Musk owed at least $500 million in severance pay under the Federal Employee Retirement Income Security Act. A district judge in San Francisco ruled that the employees' claims weren't covered because the company had said that anyone let go after Musk's takeover would only get cash payouts. Samsung's largest labor unit has declared an indefinite strike. Thousands of workers had rallied earlier this week outside its chip-making factory south of Seoul. It was originally planned as a 3-day walkout demanding better pay. But now an indefinite strike raises the risk of disrupted production at the world's largest memory chip maker. And the exodus of families from large U.S. cities is deepening. In New York City, the number of children under 5 has fallen by 18% since the pandemic. That according to a report from the Economic Innovation Group. In Cook County and L.A., under 5s fell by at least 14%. The loss highlights the risk of an urban doom loop as cities struggle to retain families, one of their most important demographics. And that's your brief. John.
Those numbers are shocking. More from Danny in about 30 minutes. Up next on the programme, a Democratic Party divided.
I believe Democrats will win up and down the ballot. Joe Biden will be reelected, and we're going to take the House.
He just has to step down because he can't win.
Two very different views. We'll get you a different view up next on the programme. Six days of gains on the S&P 500, looking to make it day 7. We've equalled the longest daily winning streak of the year so far. On the S&P, we're up by 0.1% this morning. Lisa said it earlier. We're not talking about major gains. We're talking about gains of a little more than 2% over those 6 days. And yesterday, we squeezed out a 6th day of gains because within this equity market, you think about what's got us here, what's driven us here. It's a handful of big tech names. And maybe you'd consider Tesla one of those big tech names, certainly part of the Mag 7. So this morning, Tesla is up in a pre-market again, this time by 0.6%. This one has made a big move. Over the previous 10 days, on the longest winning streak of the year so far, over that period, we're up by more than 40% over 10 trading sessions. Over the last month, that number's like more than 50. Bramo, it has been quite stellar.
The longest streak going back to June of 2023, and it comes with about a 75% gain since the recent lows back in April. This is still a name that is far below its peak in 2021. I just wonder what's driving it. You could say it's some of the technological advances that they've promised to come in August. We've been hearing about that, as you pointed out, since April. My question is, are people just looking for what might not be as overvalued as something else, but could be hinged to this AI trend as people just rotate through the same names while the rest of the 493 stocks actually had losses yesterday? Majority of stocks actually lost value. It's just a strange market, and you wonder whether it's, people kind of still not being fully relinquishing their FOMO kind of mantles.
We've had 5 different conversations, 5 different flavors with the same conclusion, which is buy NVIDIA and buy AI. It's felt like that now for the best part of 12 months.
Even as people say these values are getting a little bit overheated and it's making them nervous, they're not saying sell NVIDIA. And that's fascinating to me. Even as people get nervous about it, is it career risk to your point? Is it because you can't get bearish on a stock that still has performed in the earnings? These are some of the questions people are asking.
Well, Citi is making a change. This is what they've got to say. It's time to take profits in the biggest AI names. Citi's Drew Pettit writing this. Sentiment around stocks with high exposure to AI is the most elevated it has been since 2019. We advocate taking some gains in AI high flyers and redistributing more broadly across the theme's value chain. Drew joins us now for more. Drew, it's wonderful to have you with us on the programme. Lots of people talking about your note in the last 24 hours. I think we have to draw a distinction, as you have done, between the AI enablers and perhaps the AI adopters. Can you help us work through your framework for thinking about equities at the moment?
Yeah, well, thanks for having me on this morning. So when we think of AI, we think of it in three pieces. The enablers, so the semiconductors, the picks and shovels. We get that. That's the trade that's really working. The creators, so the software side of things. After you have the hardware, you have to teach it to do something and package that in a product. And then I think the last category, it's the users. So you call them the adopters, we call them users. Those are the companies that are going to take those tools and either integrate it into their products to make it better or in their background processes to make their companies more efficient. So I think that whole value chain eventually benefits, but the market is just trading the enablers right now.
In part, Drew, because it's very hard to see where the money is. And we haven't seen it in the earnings for some of the end users. So why is this the right time, in your view, to make that shift?
You've just had that almost parabolic move in some of these high flyers. Like you see that with NVIDIA. TSMC overnight is up another 2%. So a lot of these names, with how aggressive they have moved, portfolio managers are overweight. So we're not saying dump these names, because to your point earlier, yeah, there's some career risk there if you're not in them. But if you're overweight, use that to fund the next leg. It will come. Markets don't stay on the same theme forever. And in some cases, I think the implied expectations with these enabler stock prices moving very far, very fast, get really hard to meet and exceed going forward.
You know, it's fascinating to me, Drew, because on the surface, your call sounded quite bearish, actually. The idea of it's time to liquidate some of the positions, it's time to take profits. It screams as, okay, get out of NVIDIA. And then you start listening to what you're actually saying, and it's actually incredibly bullish. It's that we haven't valued high enough some of the AI gains, and you could get better gains in other names that haven't made parabolic moves. How do you sort of reconcile that at a time when people are concerned about valuation, when people are concerned about a weakening growth picture? And frankly, there is that kind of uncertainty of whether we're actually seeing the profitability in some of these companies.
So to me, again, we're focusing on larger cap, already profitable stocks. But I hate to say this, but I don't really care about traditional valuation metrics. Don't talk to me about a 50 PE stock that's in the early innings of a new growth phase. What we do is we look at the market price today, make some assumptions about the discount rate and what the terminal value should be for the company, and we try to figure out what kind of growth rate do I need in the next 5 years to justify the stock. And some of these stocks do have expectations, like sell-side consensus expectations, that tell me they can meet what the market's pricing in. So that's why we don't think AI is a bubble yet. Yes, it's getting extended. Yes, price moves make you antsy. Yes, some of the options data makes you a little nervous. But really, there is a growth and fundamental story here. That's why it's not a bubble, at least not yet.
At least not yet. What would take us there then, Drew?
If you really don't see increased beats and raises from a lot of the AI pure plays, I think number one, you have to recognize when stocks move this fast, it's more than just good earnings. You need to change future expectations as well. And then if prices keep moving this way without fundamentals following them, that's the concern. That's what really got us in the tech bubble. I think that's the big difference from then to today.
Drew, I think we're all interested in just how clients received this call yesterday. Just trying to gauge sentiment. Did they push back? Did they engage with it? What was it like yesterday?
I was actually a little bit surprised that there wasn't more pushback. I think a lot of people actually were on the flip side. Like, I am getting nervous. I am worried that we are pricing in too much. So it was actually relatively well received. But on the flip side, I'm not sure people are ready to hedge. Again, that's not our base case, but we always have to recognize when we could be wrong, because markets make a lot of smart people look silly over time. And people weren't ready to consider the hedge or the complete other side of the trade. So there's still a lot of AI bulls out there, but they're cautious bulls.
Drew, appreciate the update. Really do. Thanks for making time for us this morning. Drew Pettit there of Citi. The latest call on AI.
Yeah, it's fascinating. A lot of people are talking about this sort of three-stage cycle that you're expected to see in AI. I spent some time trying to understand the way that AI comes up and generates these ideas. And it just, the more I learn about it, the more I wonder how much we're overestimating how quickly it's going to be able to really take over complicated human types of tasks. Maybe it will be a more efficient way of doing business, of calculating data, of having data sets. But replicating creative thought, I don't know if it's there yet. It's just sort of an interesting concept.
He said it, and I think you asked the right question. He talked about enablers, chip makers, creators, software, and then he got to users, adopters. How close are we to that final phase? And how can we identify which winners are going to be the ultimate winners off the back of that?
That's the problem, is we haven't seen it in the numbers. There haven't been that many companies that have come out. I think of Snowflake. It came out and said it really wasn't seeing the same kind of boom or the same level of gains that people were talking about, and all of a sudden their stocks tanked. I don't know that people have a full understanding of just how AI will be deployed to make their businesses that much more efficient. Some places like healthcare, banks, I'm very curious what JPMorgan and Citi and Wells have to say about this on Friday. You could see where that is sort of this sort of objective data sets that they could use. Beyond that, it just gets kind of a little bit less clear.
Reluctant bulls. I did like that. I think you can always gauge something and how clients have received something. Just like one data point on sentiment. The absence of euphoria, I think, and heads in the sand based on what he had to say.
It's felt like that for a while, which is the reason why a lot of people say you can't bet against it. Because until there's that euphoria, there isn't the bubble yet.
Equity futures right now positive on the Nasdaq by 0.25%. Next on this program, we'll catch up with Lisa Coleman of JPMorgan Asset Management from New York. This is Bloomberg. Live from New York City, welcome to the program. Equity futures look a little something like this on the S&P 500, positive again by 0.1%. 6 days of gains on the S&P, equaling the longest daily winning streak of the year so far. Over those 6 days, Lisa, we are higher by 2.13%, and we only just squeezed out a day of gains in yesterday's session.
Wow, that's such an incredible gain. Yesterday's gain was an incredible 0.07% on the S&P 500. It was 0.15% on the Nasdaq. The point here is, when you look at some of the gains, it's just creeping across the line. This is not a rally with conviction. It is a rally that is directionless with nothing to stop it. And that, I think, is the key point, with most of the names actually underperforming and losing value over the past couple of trading sessions.
Over the same period, small caps down, and down hard. The outperformance, of course, on the Nasdaq 100. That's the equity board. Switch up the board and get to the bond market, and we can talk about some of that issuance. The debt supply coming a little bit later. 427.24. Yields are lower on a 10-year by 2 basis points. Two things to watch. 10 a.m. Eastern time, we'll hear from Chairman Powell. 3 hours after that, we'll get some 10-year debt.
This, to me, actually could be really interesting. And tomorrow we get 30-year notes. Today we get $39 billion of 10-year treasuries being sold. How much do people start to highlight their reluctance to really get into duration as a result of the deficit? Look, a lot of people say nobody cares about the deficit. It's been there for a long time. On the margin, some people say if you look at the valuation and the term premium, it is higher than it otherwise would be. There is less conviction about going into longer-term bonds because of where the deficit is versus growth, and where that sets us up potentially for a response function and into recession.
I don't know if you saw this story yesterday, but just sort of a side note on maybe not the Treasury market, but other bond markets. Did you see the reporting on the Saudis warning the G7 about confiscating Russian assets? Did you read that yesterday?
Yeah, they were concerned about what this would mean, or basically, I think they were saying we have some leverage because we own a lot of European debt.
And then on the record denied it, but ultimately insinuated that if the G7 went ahead with this, they would start selling some of that debt they were holding.
That's been sort of one of the fears, right? That if people basically weaponize the assets that they hold, that could become a problem. We heard that with China moving away from treasuries and moving more toward gold and other types of currencies. We haven't seen that, though, and the dollar's been incredibly strong. So it becomes difficult to sort of square that with the market moves and some of the ownership that we've seen.
Some of the geopolitics around the debt market for you. Let's finish on Europe and talk about what's been happening over there. French debts have not been sold. It's been bought. Yields are lower by 6 basis points. We're down to about 3.18 on a French 10-year. The rally continues over in France on the equity side. A bounce back there by another 0.5%. And the euro okay at about 108.23. I think the fate of the euro on the dollar side is what we get on CPI next Thursday, this coming Thursday, on Thursday morning.
I actually think that it's going to be a really important print, not for the actual number, but for the market reaction, because any kind of upside surprise, massive reaction, downside surprise, also massive reaction. Think about how people are kind of looking at this CPI print as highlighting whether the Fed's going to cut in September or not. And that's sort of how it's been set up among many guests who've come on this show.
And maybe even sooner. I think a lot of people sort of like scrubbed out July, but, you know, Why not? Under surveillance this morning, Donald Trump teasing Florida Senator Marco Rubio as his running mate, but stopping short of making an official announcement. This comes ahead of the Republican National Convention next week. We still don't know. It's sort of classic Donald Trump, wants to make this sort of the VP sweepstakes, and we'll find out what we get, I guess, next week, early next week.
It's got to be, right? Because it's the convention. You're going to have Trump XXX ticket. Who's it going to be? He's saying he's under some pressure from his campaign that he needs to come out and make this announcement. Yesterday, he really toyed with Marco Rubio. He started talking at one point about this idea he has no tax on tips. He said, maybe we can get that through Congress. Rubio, will you be there to vote for it, or will you not? Anyway, you'll be part of it. So he really toyed with Senator Rubio right there in his home turf of Florida. But this is Donald Trump's show, and he is going to make an absolute show of the VP stage.
What's funny about that, of course it is Donald Trump's show, but at the moment it's someone else's show too. You just get the feeling that they haven't announced the VP because they want to keep it the Biden show for the next few days at least.
Yeah, there's that, and it's The Bachelor, VP style. I mean, that's what we're talking about. Is it Rubio? I don't know. Is it J.D. Vance? I don't know. Come down with a rose. I mean, at what point is that basically what we're looking at?
Well, also...
Watch The Bachelor. Sounds like you have. Yeah, you could tell. Yeah, you started talking about the roses. You know that I have too.
I know.
All right, let's talk about Microsoft instead. Good show. Microsoft and Apple giving up the chance to be observers on OpenAI's board. The surprise decision coming amid growing scrutiny from antitrust regulators on big tech's influence over AI. Now, there are two interpretations around this story. One is a kind one. They don't need the oversight anymore. They don't need to be there. Another one is sort of like Lisa's stance on it, mine too, slightly more sceptical. They don't want to take any kind of view on what's happening within the company because they don't want to be seen to be too close to the company because they don't want the antitrust scrutiny that comes with it.
They want to use the products and have a connection with them, and they don't want regulators to sort of hammer them for it, considering the fact that potentially, if OpenAI is coming up with the programming that actually will take off, they could have a huge amount of control over how data is used and what types of ways it's funneled into end results. So they want to step away from that, but I doubt that it is because they just have so much confidence that everything is just hunky-dory and swimmingly.
We've all got so much faith in the board and the future of these chatbots and OpenAI, no? OK. All right, big banks kicking off earnings season with Citi, Wells Fargo and JPMorgan reporting on Friday. JPMorgan Asset Management's Lisa Coleman writing this. Mid-sized and super regional banks are moving beyond concerns of a year ago around deposit outflows. We'll be looking at Q2 results to corroborate these views. Lisa, I'm really pleased to say, joins us around the table. Lisa, good morning to you.
This makes me nervous to be quoted, but great to be
Was that an OK quote?
That was an OK quote.
OK, so we can start there. We can start there. It's good to see you. It's been too long.
Nice to see you too.
Let's talk about what's happening in the financials. Why are we so confident we've left behind the stress of last year?
Yeah, so look, I mean, when we look at what happened last year, we saw such a dramatic drop in NII for the banks. And particularly for the regionals, this is super important because unlike the large banks, the fee income is not a key part of really their earnings. So we're looking closely at NII. While we think we'll still see NII down for this year, we're going to see a slowing in the pace of decline. Why do we think that's happening? We think deposit betas are finally stabilizing. Remember, the banks had to pay up for deposits. That was very costly for them, and now that's stabilized. So that's the first point. The other thing is that when we think about where we could see losses on the balance sheet, so commercial real estate, obviously a hot topic, we think that the banks now are currently reserved to about 10% losses. We think the banks, because of their earnings power, have the ability to reserve more should additional losses be needed. And we've actually stressed some of the regional banks, and these are the mid-sized regional banks. We're not talking about the tiny ones, but the mid-sized regional banks and the large ones. And what we found is that even with a 20% loss in the commercial real estate portfolio, specifically office, they have the ability to generate enough earnings to allow the ability to cover that additional reserving.
One thing we struggled with through this cycle is whether high rates or low rates help or hurt these banks anymore. Because typically we talk about higher rates being beneficial for banks until last year happened. Do lower rates this year, if we get rate cuts, does it help this particular investment?
You know, I think what's happening is, so I think you're talking about these mark-to-market security portfolios that for regional banks haven't had to run against capital, so AOCI. And I think what's happened is as time has passed, some of these portfolios have shortened, they've rolled down, and so those losses are not as great as they were, let's say, a year ago when we were looking at them. But I think when we look at the regional banks, I think they're also a little bit more asset sensitive. And so in a funny way, higher rates for longer may actually be more beneficial for them when you look at the asset side. So, loans repricing and the like. The thing that would make it even better for them would be if we got some loan growth, and we haven't seen a lot of loan growth.
I was reading some of your research, and you're talking about how AT1s, contingent capital bonds, are a key part of your portfolio. They were sort of maligned during the whole Credit Suisse episode, right? You're talking about European banks in general and bonds of those companies. A lot of people would look at this and say this is incredibly risk-on. This is sort of hinged to some sort of global economic recovery. Is that an accurate way of putting it, or is it just simply a valuation issue and a fact that if you get paid 7, 8%, 10%, looks pretty good if you keep getting paid?
Yeah, I think you're right. I mean, things have shifted in terms of how we think about the European banks. They are very different today than they were even back in the time when we had negative rates in Europe, right? Because now banks have earnings power. And so when you look at what happened as the ECB started to raise rates, we started to see these banks finally starting to generate some earnings. And what's been particularly interesting is in peripheral banks, the deposit betas have remained relatively low, at least compared to what we've seen in core European banks. So Italian banks, Irish banks, NII has been really high for them. And while it's coming down a little bit now, it's still helping to generate a lot of earnings power. And, when you talk to the equity investors, they are beside themselves because they're getting, buybacks and dividends and the like. So, it's a very robust story. And what's been remarkable is the losses have been relatively low for these banks. So, it's a different kettle of fish.
If you live in Italy or Spain, do a better job demanding higher yields on your deposits. That's all I can say, because that's how I interpret what you're saying. Just when you broaden out in the United States, you pointed out to this pretty amazing statistic that about 30% of non-financial companies in their universe have had some benefit from government stimulus programs or the build out of AI, et cetera. When you take a look, you're talking about Europe. In the U.S., how much is that a tailwind that has been understated in terms of corporate quality and giving you confidence to go into a number of companies?
Yes, I think you're absolutely right. It's been completely understated to me. And if I could just take a step back, when we look at the macro statistics, the top-down numbers that were coming out, for a good part of last year and into the beginning of this year, they were giving the impression of things being weak. And yet, underneath the surface, there was a strength. And I think what happened is people underestimated the impact of this fiscal stimulus. Remember, it was announced some time ago, but it's taken a period of time for that money to actually make its way through the system. So the loans and the grants are now finally starting to be dispersed. But remember that even beyond the disbursement of these monies, you're going to have tax credits that can persist for many years. And it's interesting, right? It's in a number of sectors. The obvious ones, people think about the CHIPS and Science Act, but utilities are beneficiaries, right? When you look at the Inflation Reduction Act, energy companies are beneficiaries. So I really think it's going to have a lasting impact as a tailwind for these companies for the next couple of years.
How does November change that, though? Is there a chance that Trump could, if he was elected, unwind some of these?
Yes, and we've talked a lot about that. And I think really the difference that might prevent some of these programs from getting unwound. Granted, EVs are probably going to be something that's going to go. But when you look at, for example, energy companies, if you're a large oil company, you can get a tax credit for carbon capture. I'd be surprised if the Trump administration would take away something from an energy company. Or if we look at where some of the factories have been getting built, like the battery belt, those are in red states. Do you really want to take away jobs in red states? Probably not. So we think, yes, there'll be some adjustments, but I don't think it's going to be a widespread repeal of what we've seen already put in place.
So they need to pick and choose their battles depending on where the state is and potentially what the company is. Yeah. How broadly are you thinking about the impact of the election, though?
Yeah, it's tough without really knowing what the policies are. We hear and we think that some of the programs, if the Trump administration comes back into office, could be more inflationary. We've talked about tariffs and the like. It's hard for me to really gauge that. So really what I'm trying to focus on is what's going on with companies from a bottom-up basis. And when I look at what's going on with companies today, we're actually focusing EBITDA growth, so our measure of earnings, between now and the first quarter to be up about 6%. And that's pretty good. That's about in line with the 20-year average. I don't think a change in administration is going to have any impact on that. That's already in place. And we'll get confirmation of that as we go through earnings.
It's even harder when you're not sure who the candidates are going to be either once you get to November. But we'll leave that there. Lisa, it's good to see you.
Nice
as always.
to see you too.
Thank you for being with us. Lisa Coleman there of JPMorgan Asset Management. Let's give an update on stories elsewhere this morning. We can do that with your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. TSMC overnight reported sales that grew at the fastest pace since 2022. TSMC is the sole supplier of NVIDIA and Apple's most advanced chips. And those AI chip orders helped to make up for lackluster smartphone sales, leading to revenue that grew 40% in June. The estimate just over 35. Houston is grappling with blackouts, blocked roads, internet disruptions, and spotty access to gas in the aftermath of Hurricane Beryl. More than 1 million homes and businesses are likely to be without power until at least tonight, according to the region's main utility provider. Beryl, now downgraded to a post-tropical cyclone, is carving a path to the northeast with 30-mile-per-hour winds. The National Weather Service warned of flash flooding risks for northern New York and New England today. And Spain is headed to the Euros finals after a 2-1 victory over France. The first of Spain's goals was shot by Lamine Yamal, who is only 16 years old, the youngest to ever score in a men's European championship. Spain will now play the winner of today's Netherlands-England match, where I will be glued to my TV at 3 p.m. Eastern. And that's your brief, John.
With Bloomberg TV up at the same time, of course, Dan.
Of course.
Thank you. Yamal, what a player. Honestly, 16 years old, turned 17 on Saturday before the final.
The maturity to be able to deal with that kind of pressure, with that kind of gamemanship, is just beyond imagination for a 16-year-old.
Absolutely phenomenal. Can't wait for the final later this weekend. Up next on the program, a Democratic Party divided.
I believe Democrats will win up and down the ballot. Joe Biden will be reelected, and we're going to take the House.
He just has to step down because he can't win.
That conversation up next. Equities here positive by 0.25% on the S&P 500. The lift continues in this equity market. Yields are down by 2 basis points. The 10-year 4.27. Under surveillance this morning, a Democratic Party divided.
We must get behind him. We must support him. Donald Trump's election would be extremely destructive to American democracy.
House Democrats are very confident in the agenda that we have been a part of for the past few years.
I believe Democrats will win up and down the ballot. Joe Biden will be reelected, and we're going to take the House.
He just has to step down because he can't win.
It's the latest. Congresswoman Mike Sherrill of New Jersey becoming the 9th House Democrat to call on President Biden to drop out of the race. Biden's campaign working to restore confidence in his candidacy and bolster support from progressive leaders around the country. Joining us now, I'm pleased to say, is the Democratic Congressman Jonathan Jackson of Illinois. Congressman, thank you for being with Bloomberg Surveillance this morning. I just want to share a quote of yours with our audience, which I think is going to imply where you stand. I think he's up to the grueling call of the presidential campaign season. A question I would have for you, Congressman, I think is a question that a lot of people in this country have too. It's not just about the 4 months ahead of us. It's the 4 years after that. What gives you the impression that he can handle not just the campaign for the next 4 months, but the 4.5 years of governing he'd still need to do?
Well, I think he's got a great team around him. I think his agenda is clear. His focus has been very precise. When I think of what the alternatives that we are confronting at the moment, it's about direction, it's about character. President Biden has been very robust on the campaign trail in the last week since that debate, if you will. And so I'm very excited for him. I think that he's got a very strong number 2 in Vice President Kamala Harris. And he was able to share with us as the CBC members on a private Zoom call. He was able to take our questions. And so I'm very excited. I'm very confident that he can go forward, and we'll go forward in a very robust manner.
If you think he has a strong number 2, and he's 81 years old, and the polls continuously show, not just post-debate, this has been an issue with the electorate for over a year, that they just think he is too old to continue, why not promote the number 2?
I think he has been promoting Vice President Harris. And so we don't know what the future holds. But I would tell you this, that they've been out on the campaign. This has been a scandal-free administration. He's been very focused. If you look at what the alternative is on the chaos, the confusion, the calamity, if you will, I think the press has not put it in the proper light. If you think at a person that's been convicted by a jury of their peers of sexual assault, you usually get a handle on your name being called a sexual offender, former president. But no, they've given him a pass on that. So character is on the battle. And I think the African-American community is very clear at what's at stake. We've gone in the wrong direction with the United States Supreme Court. If you will, we've had 116 justices in American history, roughly 12,510 representatives in the House of Representatives. We've had 46 presidents. But this non-elected group of people that sits on the United States Supreme Court is able to dictate law. I think we need to look at some sort of judicial reform in the future, that the power that they have and the corruption that they've displayed is unprecedented. So the Supreme Court is on the ballot for this election season as well. And I would trust President Joe Biden and Vice President Harris to make that decision and recommendation before the American people.
Congressman, I want to share you some new data we got this morning from the Cook Political Report. They said that Trump's currently is 47 to 44% lead, the most dramatic shift they've seen in this race. And David Wasserman, an analyst there, said, quote, Trump's current numbers among Black and Latino voters are incompatible with any plausible Democratic victory scenario. What does Joe Biden need to do to really shore up the Black and Latino communities?
Well, I think he has to continue to stay in front of the community and also share with them all the things that he's done and what's to be promised in the future. It's we know on the Sunday before the Tuesday election, most Democratic candidates find their way to the African-American church. There are some more gains that the African-American church certainly deserves in the African-American community. If you think about what President Biden has done, one thing that's huge, and there have been many things, is that this is the first time an African-American woman was even considered to go onto the nation's highest court in Ketanji Brown. And her opinions and her decisions, her character is very important for us to have there. What he's done on trying to put people on the judiciary has been very outstanding. We're now seeing the erosion of African-American wealth. We're looking at going towards 2050 where there'll be zero African-American wealth that's also being projected. If we can talk about peace and security in Ukraine and Israel and Gaza and Taiwan and talk about rebuilding plans, we can talk about rebuilding urban America. Those persons that have had the history of being the descendants of Americans that have been enslaved, that have faced redlining, that have faced all the worst of America, that have been truly American since the founding of this nation, have not had an economic plan that has been sustained and has been implemented. Our cities don't have to look this drab and this dire. We can also pick up people in America. And once we do so, we will expand the market. I believe in America, I believe there's a lot more potential. When we saw the past of segregated athletic fields, once they were transformed into a level playing field, now we're proud of the NBA, proud of Major League Baseball, proud of all of these other endeavors. We can do that same with our economy. When people have equal access to capital, that has to be a major focus of the Biden administration. What are going to be the financial institutions created to have long-term sustainable growth and inclusivity in the American economy? That's a promise, that's a commitment that should be made to the African-American community. It'd be good for America, it'd be good for the world.
Congressman, I want to go back to what you were talking about at the outset, where you were saying that it's character on the ballot is who you are going to elect as just a person, a candidate, and you're talking about Donald Trump. There are a number of polls that have shown that Kamala Harris or many other candidates would do better than Joe Biden across from the ballot, across from Donald Trump. Why are you still supporting Joe Biden if you think that he has a lesser chance than other potential Democratic contenders to win in an election that you're framing as quite important?
Well, I would say it this way. You're talking to someone that's in elected office, and anyone that's been in this position before, you understand critics come after doers. And so we don't look at all the opinion polls. Opinion polls will tell us we're wrong. Opinion polls will tell us that we can't win, and we've overcome many of those obstacles. We're in the position now of molding and shaping opinion, and that's where I stand on the side of. I appreciate those that have dissented. I disagree with them. I think it's healthy that we have debates. I would have liked to have seen a more rigorous primary debate schedule that gives other persons the opportunity to get on the stage, but here we are. We're about 4 weeks away from the Democratic convention, and I think these different opinions and party persons that may disagree, I disagree with them, but I respect their opinion. I think in the end it all comes together. And so I don't want someone to be crowned the next president. If someone has a dissenting voice, I want them to be heard at the convention. Let's keep it open. Let's keep the conversation robust. And let's take our case to the American people. This ultimately is decided not by the donors, but by a radical proposition, and that is that every person has a vote and it counts on election day. One person, one vote. And so this is where the billionaire class and the working class all have one voice, one vote on election day. So I follow opinion. Now it's time for us to shift opinion, not simply follow what the opinion polls are saying.
Congressman, I wish we had more time because we've got plenty of follow-ups to that particular last comment. Congressman, thank you. Congressman Jonathan Jackson of Illinois joining us from Washington, D.C. I know you wanted to jump in right at the end.
Well, he's a staunch supporter of Biden, but he said he wished there was more of a rigorous primary. Was this an error?
An opening to debate a little bit later on this summer in August.
Yeah, and this is the key. They're trying to shift opinion that has not gone their way. The question is, what if they can't?
The third hour of Bloomberg Surveillance up next. Tracie McMillion of Wells Fargo, Craig Trudell of Bloomberg News, Stephen Englander of Standard Chartered, and Veronica Clark of Citi. From New York, this is Bloomberg.
This is a market that we still see as fairly constructive. We believe the equity market rally can continue to trudge higher.
These concentrated moves and these handful of names have really masked everything. With markets at the highs, again, markets don't have to stay at the highs.
We get caught up in the broad indices. You look below the surface, markets are only doing okay.
It just feels like there's very few bulls out there. Everybody that comes on has kind of a bearish tilt to them. And bear markets don't really start that way.
There is an unprecedentedly wide range of outcomes possible. So no longer can we think about investing around a central base case.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. Looking ahead to day two of Chairman Powell on Capitol Hill, Neil Dutta of Renmac writes in, the chairman understands the trade-offs have shifted. That's important. Now they need to tee up the cut. I don't think anyone's expecting that a little bit later this morning.
He's not going to come out and say September is on. I did hear from Neil Dutta as well when I was saying that we're up by 0.07, saying, come on, Lisa, up is up. So we did see at 36 the record gain on the S&P 500, regardless of what we hear from Fed Chair Powell. But what we are hearing under the surface is that Fed cut is crucial to a lot of the bullish calls later this year.
What we heard from him yesterday, he said he wouldn't give us clues on the timing of a policy change, and then he kind of gave us clues on the timing of a policy change by acknowledging that elevated inflation was not the only risk. And I think this is really important. This is the shift from the chairman. This is about the shifting balance of risk that people like Neil Dutta and many other people on Wall Street are thinking about. For the last 2 years, almost exclusively, we have only talked about one side of the dual mandate because the other side was so strong you didn't have to look at it. Labour market was good. Let's focus on getting inflation down, hiking interest rates, staying there and remaining restrictive. Now you start to see some fraying of the edges, which is what Kathy Bostjancic of Nationwide said to us a little bit earlier this morning. Claims starting to tick higher. Unemployment starting to inch up. There's a reason to have that more balanced view, to acknowledge the two-way risk, that risk cuts both ways, not just look at price stability, but look at full employment too.
As he was saying, this is not an overheated economy, and the specific language, elevated inflation is not the only risk we have. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. Does this put on the table, if there is an undue weakening, of course, I want to hear what undue weakening means, do they cut by more than 25 basis points? You know, what is on the table? What are they looking at for their metrics? They won't tell us, but we'll ask.
He also talked about, to your point, Jonathan, the labor market cooling. And as he said that, he said considerably from where we were 2 years ago. And I wouldn't have said that until the last couple of readings. And that's why I think everyone says, OK, now he's teeing up the cut. He's ready to go. He's talking about the fact that the data has been moving to his side to do this. I was struck, though, not just by what Neil Dutta said to you in a private message that you shared with us earlier, know something Sherlock, but what UBS put out today from Paul from The Economist. Perhaps Federal Reserve Chair has opened an economics book. Powell told the Senate Banking Committee that cutting rates too early would be bad, but cutting rates too late would also be bad. Unfortunately, the Fed chair insisted that more, quote, good data was required to induce a rate cut. The market is just ready for it. And that was from Paul Donovan.
Paul Donovan, cutting, bruising, brutal. Look, they've been stung before by a couple of head fakes. We've had the chairman come out in the past and talk about the disinflationary process has started, which has given the impression they can back away from this restrictive policy. And then Q1 happened. After Q1 happened, when you started to get these upside surprises on inflation again, they just needed some economic data to give them more confidence, give them specifically the confidence that Q1 was a head fake. So when they talk about needing more confidence, I think that's directly what they're talking about. The Q1 was a head fake. We can move on. We won't be in the history books for making the wrong decision, a la the 1970s move, and we can look at protecting and insulating this labour market. I think the question that a lot of people have, including Neil and others, is that if you wait and you keep waiting, there's a risk here that you might be too late. And if you think about the decision in front of them, and certainly this is not a criticism, I think this is really difficult. What is the biggest risk right now? Holding too long? Cutting too soon? And you can just hear it in the commentary on the Wall Street side of things that they believe it's holding too long and not cutting too soon. And that's a change in the last 12 months.
Especially because you have two prongs of the dual mandate of the Federal Reserve. It is unemployment or the labor market, and it is inflation. And if you look at both of those metrics, they both are moving in a direction that would send a green light to them to cut rates. So a lot of people are saying, why wait? This is, to me, the issue, because if you're conditioned by recent events, you think, wait a second, we might not know what we know. And that's why I want to understand even how they are looking at the current economy that a lot of people are saying is very different than one that we've ever seen before.
CPI data coming on Thursday morning. Equities right now on the S&P 500 going into the opening bell, just about positive by 0.25%. Yields a little bit lower, down 2 or 3 basis points. 426.66 on a US 10-year. Coming up, we'll catch up with Tracie McMillion of Wells Fargo as stocks hit their 36th record high of the year. Bloomberg's Craig Trudell with Tesla on track for its 11th straight day of gains. And Veronica Clark of Citi looking for the Fed to start cutting in September. We begin with our top story, the S&P 500 hitting its 36th record high of the year so far. Tracie McMillion of Wells Fargo saying investors should rebalance to avoid portfolio equity concentration risk. She recommends trimming tech and communication services and adding industrials, materials, energy and healthcare. Tracie's with us now for more. Tracie, let's talk about that. Your picks on what to trim and what to add to. What's behind both?
Yes, thank you, John. So market breadth, as everyone has been talking about lately, has been extremely narrow, with the top 5 names so far this year contributing about 60% of the returns. And a lot of that is coming from communication services and information technology. In fact, those are the only 2 sectors that are outperforming the broader S&P 500 index. So we think that it makes sense to take some gains out of those 2 sectors and then look at those sectors that should benefit from a broadening out of the earnings recovery later this year. And we see sectors like healthcare, energy, industrials, and materials benefiting later in the year from that broadening.
Tracie, putting that together with your Fed call, you only see 2 cuts in 24, I think 1 as well in 2025. If you're looking for that, plus a broadening of the earnings backdrop too, it sounds like you're pretty constructive on this economy. Is that fair?
Yes. So we are expecting growth to continue to slow. We do think that we're going through a soft patch here, but we think it will be a moderate soft patch. And as the Fed starts to cut rates, we do think that that will help to stem some of the consumer weakness that we're starting to see. And we also think it will make credit more available. And those 2 things we think will lead to a modest recovery as we move into 2025. And so our targets are higher for U.S. large caps in 2025 than they are today. We do see some probably choppiness here through the end of the year, but looking out a little further, we do see that prices could easily be higher by the end of 2025.
Tracie, this is fascinating to me because of also how similar it is to Dan Skelly of Morgan Stanley, who was on earlier, talking about how he too is expecting a broadening out. He too is seeing even areas that face consumers, that depend on consumers, that are more highly leveraged, that are in the sort of weaker cohorts, as doing better as the Fed cuts rates. Is this all contingent, Tracie, on the idea that the Fed will cut rates in September or sooner to sort of get the cycle started, and then you can start to see the true broadening, and you're trying to get ahead of that?
Yes, our base case is that scenario exactly, Lisa. However, if the Fed does not cut rates, it's probably because the economy is actually doing better than anticipated, in which case we would expect earnings to continue to improve and continue to support prices.
This is sort of the push-pull that people have right now. If that does happen, though, the actual participation of certain names will change because this has been a very bifurcated economy. Is it too soon to sort of go full force, in full throttle, into some of the broadening out trades, into some of the other names that haven't really kept pace with the Magnificent Seven? If the Fed hasn't cut rates yet and you're not certain, and where things are now, that kind of strength would just support what we've seen as already winning.
Yes. So, really what has been winning is the AI-fueled trade. And this is a long-term trend that's playing itself out in phases. And phase one is that direct investment in technology stocks that are going to benefit from the new technology. Then phase two is really the data center build out, the capacity build out, the energy needed to support that. So that should support materials, industrials, and energy. And then phase three is those companies that are going to benefit from improved productivity. And healthcare may be among the sectors that would benefit most there. So we do continue to support that broadening out into other sectors away from communication services and info technology, although we still have a neutral position there, so we're not underweighting those sectors, but we are saying take some gains and spread it out a little bit.
Tracie, you talk about momentum being the strongest factor driving this equity market. What's the biggest risk or vulnerability then to that?
Yeah, so the biggest risk is investor sentiment. So liquidity has been driving a lot of this market. Momentum has been driving it. And should investor sentiment start to falter, then we think that some of the momentum that's been driving the market would certainly come out. Now, what could cause investor sentiment to weaken? Certainly, if growth slows more than expected, if growth slows at the same time that inflation does not cool as much as expected, if the labor market continues to soften more than expected, there are, a number of factors that are dependent on upcoming data that will help to guide us in terms of, just how all of this is going to play out.
Tracie, wonderful to get your input. An update on your call. Tracie McMillion there of Wells Fargo. Looking for that broadening out of the earnings. We heard that a little bit earlier from Dan Skelly and Morgan Stanley as well.
Well, how much does this really hinge on the Fed rate cut? This sort of idea that will pave the way for a new kind of, earnings boom, et cetera. It's just really interesting to me to see kind of all the things that have to fall into place for that to happen, and then what happens with some of the AI stocks. I mean, basically, it's all $7 trillion in money markets being unleashed into markets, and everything wins.
It's something like that. But there are two very different cuts. And the kind of rate cut that Tracie's looking for is the more bullish, constructive rate cut, which is the fine-tuning, sort of the mid-cycle adjustment. The growth is decelerated, but growth is still OK. There is another one, right? The undue weakening of the labour market, that one. If unemployment starts to climb higher, maybe too high and they're too late, that's a very different kind of rate cut.
The broadening out call is a resounding endorsement of the soft landing call and of the idea that rate cuts are part of that as a mid-cycle adjustment.
Let's get you an update on stories elsewhere. We can do that with Danny Berger. With your Bloomberg Brief, here's Danny. Hey, Danny.
Hey, John. Donald Trump is getting closer to announcing his vice presidential pick. During a campaign stop in Miami, Trump teased but did not officially announce that Florida Senator Marco Rubio could be his choice for running mate. He did stop short of making an official announcement, but did say that he was officially challenging President Biden to another debate, this time without moderators. Saudi Aramco has launched its first dollar bond sale in 3 years. The world's biggest oil exporter is selling bonds at 10, 30, and 40-year maturities. It's hoping to raise at least $3 billion to fund several large-scale projects. Saudi Arabia's government and affiliated companies have borrowed vast amounts this year, topping China as the biggest issuer of international debt among emerging markets. And the number one at Wimbledon is out. Jannik Sinner, the world's top-ranked tennis player, was eliminated yesterday after losing a 4-hour, 5-set quarterfinal match to fifth-seeded Daniil Medvedev. It was the tournament's 36th match to go 5 sets, a new professional-era Grand Slam record. The quarterfinals continue today with Novak Djokovic continuing his quest for his 8th Wimbledon title. And that's your brief, John.
Danny, thank you. And I think a walkover in that semi-final. Novak will be in the final this weekend. A fiery Novak Djokovic. Did you see that earlier this week?
That was pretty interesting.
Going at the fans saying, you can't touch me. I've been in much more hostile environments.
Yeah, well, everybody needs to get their energy out.
He doesn't like the booze. Does not like the booze.
I get it. I think he's sensitive to the booze with the family in the crowd, with the kids in the crowd. I did notice that. But were they booing Kim? That's a very separate debate that ultimately he doesn't want to have. OK. Up next on the programme, the morning calls and Tesla looking for 11 straight days of gains. This is the 11th. We're up by about 0.5% in the pre-market. From New York, this is Bloomberg. Equities on the S&P 500 firmer here by 0.25%. Let's get you some morning calls. First up, TD Cowen raising its price target on Meta to 600 from 530. The analyst saying Meta's AI focus is driving revenue growth across the business. Next up, your second call from Needham, boosting its price target on Apple to 260 from 220. The analyst citing the decision to buy back $110 billion in shares when others are spending on Gen AI. It's an interesting one. And finally, Goldman raising its target on Tesla to 248, maintaining a neutral rating. The analyst citing better than expected 2Q deliveries, adding the reduction in inventory levels is a positive sign for future pricing. Tesla, you've seen the run, looking to make it 11 straight days of gains in today's session after posting 10 just yesterday. Bloomberg Craig Trudell joins us now for more. Craig, this is quite a run. It's 10 days of gains. We're up by more than 40%. Bill Gross, the founder of PIMCO, coming out and saying it's trading like a meme stock. What are you hearing? What are you reporting on? What is happening with this name in this market?
It's hard to disagree with Mr. Gross. I think you look at what has happened to the fundamentals that he alluded to. Goldman may sort of look at the inventory clearing that we saw in the second quarter as positive. Maybe some stabilization in the margins for this company, but those margins have been moving dramatically lower over the last year and a half as the company has significantly cut prices. And we have not seen, a sort of result of that being increases in deliveries. We've seen the company really over the last 7 quarters see very, very flat deliveries. So this is a growth company that is no longer growing. And real questions about where that growth is going to come from going forward if the company is unwilling to add to the lineup, which Elon Musk has given every indication that he doesn't want to expand the lineup, that he wants to continue to really leverage the Model 3 and the Model Y for the vast majority of this company's sales.
Well, you know what the carrot is now. It's August, and it's the robo-taxi business. We're talking about price of the company for growth that doesn't have any. Craig, can that story turn that growth story around?
I think there's real reason to be skeptical there, just on the basis of, we look back at the years of experience we've been through with, Musk talking about this and putting this on the drawing board. You go back to 2016 when he was really first talking about this idea of trying to make this a business, of putting self-driving vehicles on the road, a shared fleet of them. Tesla, running that fleet, managing it as a sort of Uber competitor. And this was all something that, was on the drawing board way back in 2016. And, really executing that has proven extremely difficult. And you look at this sort of segment leader in Waymo, they are making really remarkable progress of late in making their service available, more to the public. But scaling that business has been a real slog, and they've really focused on particular markets whereas Tesla has set a much higher bar for itself with wanting to do sort of general purpose autonomy. So how exactly they square that circle is really going to be something to watch on August 8th when Musk has scheduled this unveiling for.
I think you're very diplomatically sort of doing the collective head scratch that we all are in terms of why now, in terms of this rally that we're seeing in Tesla stock. This actually adding to that collective head scratching, given the fact that there is a report citing Cox Automotive research showing that Tesla's share of electric vehicles in the U.S. has fallen below 50% in the second quarter. They've lost ground to General Motors, Ford, Hyundai, and Kia, all of them actually gaining on them in terms of their EV sales, even as collectively there seems to be some steam lost. How much of a hurdle do they have at a time where a lot of companies might have de-emphasized the EV, but are still gaining share and creating a buyer base?
Yeah, I mean, I think, for Tesla to go, below 50% is a pretty significant milestone. It's sort of been assumed that this company was not only, dominating the EV market, but going to continue to dominate it, sort of in perpetuity. And I do think that you do hear from some people that this is maybe kind of part of the plan, this idea that the EV market is going to get more and more competitive, that Musk doesn't necessarily want to play that game, that he wants to sort of, take this great big leap. And I think that may be all well and good and be the sort of thing that you would expect of a disruptive company. But I think people underappreciate just how difficult it's going to be to get a car to where, you don't need any human behind the wheel. And I think we need to look no further than all of the money that Google has pumped into this effort for years. And really done this in sort of, step-by-step fashion. Musk, as we know, is not one to really sort of be patient, work well with regulators. And this is an industry where, one accident, one collision with a pedestrian or with a vehicle that results in fatalities can lead to you no longer being able to operate on the roads that you've been on. And so we've seen that from Uber, we've seen that from Cruise. And, I don't think necessarily that there's a reason to think that Musk is going to suddenly sort of change his ways and work better with the authorities who will give him the green light, at least initially, on the basis of the promise that this technology offers.
Craig, do we talk too much about Tesla simply because Elon Musk is such a firebrand? I mean, he's sucking a lot of the oxygen out of the room. Tesla shares are up 5.6%. I just looked at General Motors shares. They're up almost 30% year to date. I mean, how much has sort of the drama around Elon Musk and Tesla overshadowed some of the gains that some of the other auto manufacturers have made?
It is a really interesting question, and I do think that some of the gains that you're seeing among some of these other automotive names has actually been on the basis of, these companies have been spending sort of like drunken sailors to try and catch up to Tesla, and maybe it's not the best use of capital. Maybe we would be better off actually, getting some of that back in the form of a dividend and a buyback. And I think, those shareholder returns actually is a big sort of factor behind GM. But I think the reason we do talk so much about this company, you want to talk about the 10-day run that this stock has been on. I mean, it's added $250 billion worth of market cap over that stretch. And that's, multiples of what some of these other companies are worth. And so, do they get talked about an awful lot, really, until everyone's blue in the face? Absolutely. But it is, for good reason, in the sense that we just don't see these sorts of moves in terms of, market cap gains among anyone else in this space.
Craig, I want to ask you about the tariff hurdle, because rival BYD signed this deal to start now producing EVs in Turkey. Is this a way they can sidestep the tariffs that Europe has put on? And is this something potentially Musk should start doing?
I mean, they're not only setting up in Turkey, as you've alluded to, but also in Hungary. So they've already started work on a plant in Hungary. I do think it's really interesting in the sense that, the Chinese car makers have had these big ambitions to crack the European market. They've done so in a way to try and avoid the scrutiny that they ultimately weren't able to avoid in the sense that even making bits of progress in cracking this market was enough to really set off alarm bells in Brussels. And so we have seen these tariffs put into place. This would be a way around those by setting up local production. And I do think that this is an underappreciated risk to Tesla in the sense that the Shanghai plant, as of a couple of years ago, became the export base from which Tesla, really tried to leverage, and to a great degree here in Europe, where they have localized Model Y production in Germany, but the vast majority of the Model 3s they get for this region come from Shanghai. And so those are at risk of real pain in the form of these tariffs that are coming into play in the coming months.
Hey, Craig, appreciate the update. Thank you, sir. Craig Trudell out of London from Bloomberg News on Tesla. Quite a run. The best performing stock on the S&P 500 over the last month. Just a quick note on BYD. JPMorgan hiking the price target on that name by more than 80%. The latest call from them overnight. From New York City, more on day 2 for Chairman Powell on Capitol Hill. Up next. We are on the longest winning streak of the year so far on the S&P 500, equaling that run back in January of 6 consecutive days of gains. Equity futures this morning signalling we might add to it, up another 0.25% on the S&P 500, adding some weight to the rally on the Nasdaq 100, up another 0.4%. And the Russell, Lisa, trying to participate, up by 0.5% this morning.
Yeah, we've been talking about rate cuts and whether they'll be good rate cuts or bad rate cuts. One thing that I find fascinating, especially ahead of JPMorgan earnings on Friday, financials have been outperforming. They outperformed yesterday, and there is the potential for them to outperform again today. We know that small caps include that kind of bucket. That I'm actually watching most closely today.
Stand out for me so far this morning, the pushback around the politics. Dan Skelly, Morgan Stanley, Brian Levitt, Invesco, basically saying it doesn't matter. Whatever happens in November, markets are going to be okay.
People are looking at the actual profitability of the companies, and we heard that from Lisa Coleman as well, and it's hard to see how one candidate or another is going to really change that, especially given that a lot of the money that's being given to those companies is already locked in. Question is, longer term, and this is the bigger question, is for the bond market, will they wake up to some of the potential changes that could come down the pike or not? And it seems like everyone's saying that's kind of the bigger question than an equity.
Lisa Coleman was talking about going to some bank debt. We talk about tech names all the time. Yes, tech names have driven this rally. The financials, you brought them up. We're up 23% on Bank of America year to date. Goldman's up by similar amount, 22.6. Citi's up by close to 30. JPMorgan's up by 22. Look down the list. These names have had a decent run.
Given the fact that they, A, have seen a resurgence in deal activity, B, have been underwriting quite a bit of debt. We've talked about supply. It's not just on the government side. It's also on the corporate side. And then you talk about just the fact that they've been able to buy back their shares and pay out dividends in a growing amount. I mean, basically, they're becoming more of a value stock for people who previously had looked at them at growth, disappointed that they weren't, and now are sort of viewing them as a different place in their portfolio.
Let's get to that bond supply. Switch up the board and get to the bond market, the Treasury market. Yields pushing just a little bit lower. We're down by a basis point or two. It's all about the 10-year this morning, 4.28. Yesterday was about the front end of the curve. We had some 3-year debt, no problem there. We move further out along the curve as the week grows older. It's a 10-year today at $39 billion worth coming from the Treasury. A little bit later this week, tomorrow, in fact, we'll get $22 billion of 30-year debt. So just moving along the curve slowly as the week progresses.
You know, even if these are all incredibly successful auctions, I'm curious to see whether there is less appetite for longer duration bonds, given some of the uncertainty around the deficit, about pro-growth types of programs at a time where the economy is already going pretty well, and we have a deficit that's already the steepest that we've ever seen it. So these are some of the questions that people have that we haven't, okay, yeah. Brian Levitt was saying he hasn't seen the bond vigilantes. Show them to me. Fair, although on the edges we've seen people come out and just sort of express some concern.
Seen it elsewhere, seen it in the UK.
Yeah.
Start to see it in France just for a minute, maybe a couple of days, a week or so. Will we start to see it in Treasuries later this year? We'll see. I think we've got a scent of it, just a little scent of it, a sniff after that debate a couple of weeks ago. We'll see if that continues. If you want to see no price action at all, and you have access to a Bloomberg terminal, WCRS, just get a snapshot of G10 in foreign exchange. Euro's doing nothing. Basically, the whole of G10's doing nothing, with the exception of the New Zealand dollar and Norway's currency. The rest of it, barely moving. The euro, 108. 25. We're positive by a tenth of 1%. Let's get you some stories. Under surveillance this morning, industry research firm IDC saying Apple saw a 21% gain in personal computer shipments for the second quarter. It marks the largest gain for any PC maker. Tech companies are teasing new AI computers as devices age from the pandemic era. So is this going to be like this new phase of PC buying?
PCs sound cool again when you think about the fact that maybe you can get one and they have some interesting AI advantage. I was looking at Canalys research, and they really are gearing up for the next few quarters, this AI adoption to start to ramp up. And it's going to help the likes of not just Apple, but Dell, Lenovo, all of these companies, because it's like vintage. It's cool again. What's old is new.
I don't know. I'm struggling with this just because I honestly wonder what kind of AI advancements we're talking about. Is it just that you've got a cool emoji? Is that going to be enough to get people going? Is it that you have, a better search function? We talk about AI as though it's sort of creating this, new factory. I think it's important to kind of look a little bit more what it actually is achieving, because it could be different. Efficiency gains at a bank, I get. What it's going to do on your PC?
I totally agree. I'm not saying that maybe what's advertised is worth buying, but clearly it's working because they're being able to sell a lot more PCs, which notably it was buy a little bit bigger phone, get an iPad. Now it's, I actually want a PC maybe because I can tap into this AI world.
If you're really bored at the weekend, turn on the golf over the next few weeks and you'll see some commercials for new golf clubs with the letters AI in them. I don't understand it, but ultimately everyone is using those two letters to try and sell product.
But that's my point. I mean, is it an AI golf club? Is it going to magically understand the
developed with AI?
Yeah.
Yeah.
Is that it for your
Right.
perfect swing?
Apparently. All right.
8 handicap.
Yeah. 6.
6.
No, 8. He corrected it, right? It was 6.
But this was
then he clarified it was 8.
But a few years ago.
Okay. And Donald Trump doesn't believe him.
Right.
And most people that listen to that don't believe him. Okay. We're talking about the debate again, aren't we? All right. Treasury Secretary Janet Yellen on Capitol Hill facing questions from lawmakers over President Joe Biden's health.
As a cabinet secretary, have you noticed any mental or cognitive decline in any of these meetings?
The president is extremely effective in the meetings that I've been in with him. That includes many international meetings that are multi-hour, like his meetings with President Xi.
That was Secretary Yellen on Capitol Hill yesterday, somewhat evasive about when the last time she actually met the president and when they last had a direct conversation in person.
She was talking about these big international meetings. She sat with him across from other heads of state, but she wouldn't say when she was last in the room with him. She would not give that date. And then Representative Lawler went on to say, has there been any discussion amongst the cabinet about invoking the 25th Amendment? And she said flat out no. But this is a preview of more to come. Any cabinet official that, say, testifies in Congress or sits for an interview, the first few questions are going to be, what is the mental acuity of the president today?
Based on the last 2 weeks, they're questions that are warranted, aren't they, for cabinet officials?
They are warranted. And this is the tricky aspect to me. And I think that you asked the right question earlier, which is career risk, which way? What we've heard is a Democratic congressman come on this show today and say, essentially, we're trying to change the message. We're for him. We're going to back him. Whether we should have done it differently, we're not going to talk about that right now. What I want to know is at what point it is sort of career risk not to change course now, if it's going to be increasingly difficult to change that message simply with rhetoric.
Wouldn't it be good if it was just for the good of the country and not about the good of their personal career?
You're just trolling me.
I know. Fed Chair Jay Powell returning to Capitol Hill for day 2 of testimony. Powell in front of the Senate yesterday, keeping a September rate cut on the table while noting the risks of rising for the employment half of the Fed's dual mandate. Mike McKee is not bothering to focus on what's happening at the House because Mike McKee is somewhere else this morning. Mike, I understand you're at the Teton Economic Forecast Conference in Jackson. Why are you there and not down in Washington, D.C.?
Well, because it's a lot nicer out here, I think, than in Washington these days. Washington's a tough place to be. Jay Powell, though, has to be there. He can't do it via AI. But his testimony is going to be the same this morning. We've confirmed that with the Fed, so nothing new in his prepared remarks. But when they get to the Q&A, perhaps we'll get a little more of a focus both on when they might cut rates, because he sort of dodged that question a lot yesterday, even while keeping Wall Street's hopes alive, and on the politics of it. As Anne-Marie knows very well, the House is much more political in its questioning than the Senate is.
Michael, it seems like we got this sense that he is recognizing the weakening in the labor market that a lot of people have been talking about. He's talking about this is not a frothy economy. You're seeing a balance. And elevated inflation is not the only risk we face. If they don't cut rates soon enough or deeply enough, that could be a problem longer term for the labor market. I am paraphrasing that. Mike, I mean, how much are people saying that this is a shift in tone that's paving the way for a September rate cut unless something dramatic pops out to really change that view?
I think we're not quite there to say it's guaranteed, but it is a shift in tone that raises the possibility of September, puts it in play. The Fed is acknowledging through Powell, and we've heard from others as well, that the labor market has definitely slowed. We're seeing a rise in unemployment. We're already where they thought they'd be at the end of the year. You look at the Atlanta Fed GDP Now numbers, and they've come way, way down to about 1.5% for the quarter so far. Consumer spending is falling off. So they're seeing an economy that is slowing. Now, that is what they wanted. And if they are getting what they want and inflation stays well behaved, then you go back to the old question that Jim Bullard used to ask, is this the right interest rate for this economy? And by September, they may be able to answer no.
McKee, today, potentially, we're going to get more of those political questions. Yesterday, Senator J.D. Vance, a potential VP pick for the former president, asked him about immigration. And he said in the short run, it may actually have helped because the labor market got looser because there were more people. Is this the line that Powell is willing to walk? He is talking about the fact that, as Jonathan calls it, a leaky border, a looser border, actually aided what was going on in the labor market coming out of the pandemic.
Well, he was very careful to not go over the line and talk about, as he put it, the moral implications of this, whether people are legal or illegal. But we know how tight the labor market was. Companies could not find workers. So having more immigrants helped. It helped fill up many jobs out there. And going forward, the United States birth rate is falling. So immigration is important to keep potential growth up. That's all economics. So he feels comfortable saying that, but he doesn't want to get involved in the question over who should be here or who should not be here.
The politics, very different. The law as well. Michael McKee, thank you, sir, on the latest over in Jackson. Joining us now to continue this conversation, Veronica Clark of Citi alongside Steve Englander of Standard Chartered. Veronica, I want to start with you. And a key feature of your call and the team over at Citi for quite a while now has been the deceleration in the labour market, and we're starting to see it. Do you feel vindicated? Do you think this incoming information is starting to validate this view that you've had for quite a while?
It was a very out of consensus view a couple months ago when we were talking about even the possibility that maybe the Fed would hike again. We were reaccelerating, and it is easier now to convince people that things are slowing. I think it's gotten much more evident in the labour market data the last few months. You know, we're still running consistently strong payroll job growth, but I think people are aware that there's maybe some issues with that survey. Maybe it is reflecting immigration, but we have had this increase in the unemployment rate that fundamentally is telling you there are more people who want jobs and don't have them. So yeah, I think we're still seeing those signs that we're headed to a slowdown.
There is still some daylight between you and the Federal Reserve. Let's be clear about that. You believe, Veronica, that ultimately that this gets worse. When they start cutting in September, they don't really stop. That's where the daylight is now between you and I think the rest of the street. I still sense the consensus on the street is mid-cycle adjustment, fine-tuning starts in September, go a couple of times, see what happens. Are they already too late?
Yeah. So I think the issue is that if everything stabilizes here, if we're at a 4.1% unemployment rate, yes, that is still historically low. That would look great. But that's usually not how these cycles play out. They start very gradually, very slowly, and we've seen that for a number of months. You know, not even just the last couple, but 9 months ago we were starting to see these signs of weakening. And even at the start of the year, we did have this big loosening of financial conditions, and it hasn't been enough to prevent that weakening. So yeah, we're just expecting that this looks like most historical cycles, and unfortunately it gets worse.
Steve, what's your view on that? That essentially everyone's pricing in as their base case that the Fed has time, as they've said, to make mid-cycle adjustments to keep the soft landing on track. Do you agree that it's looking less likely the longer they wait?
No, I kind of agree with the Fed on this one, because if you look back to the most recent cycles that we've had, in addition to whatever Fed tightening there were acts of God, whether there was COVID, the great financial crisis, even the collapse of the internet bubble in 2000. It's been a long time since we've had a slowdown that's just caused by tightening. And, so I think if the economy is slowing down, then all the data show a gradual slowing across a broad set of indicators. But there's nothing that suggests to me that we're going to go over a cliff. And I think the Fed realizes this, that, you do 25 a meeting too early or 25 a meeting too late. The loss function, so to speak, is very flat. It's not like really steep. So if you miss it, you're done.
Veronica, what's your sort of rebut to that, considering the fact that a lot of people say it's not usually linear, these types of changes?
Yeah, I mean, usually it isn't linear, and we get that question a lot. Does there need to be a trigger? Does there need to be some external event that happens? And I don't think necessarily. I think this, could be, a traditional cycle, even if we haven't seen one in a while, where rates are restrictive and things slow down. I mean, we've seen, I think, for a while now that, firms are really looking to cut labor costs by not hiring, by cutting hours worked. What we haven't really seen yet are the layoffs, although we have seen this increase in initial jobless claims lately. But people are pulling back on spending now in the last couple months. They feel worse about employment prospects. If that means that you're cutting back on spending and that's less business revenue, maybe that's what gets businesses to that last step of layoffs. And those can really build on each other.
Steve, your reaction?
I'd say historically, it's very hard to find nonlinearities. I mean, especially when, the nonlinearity would be like a great financial crisis or some big event. And, you look at the labor market, you sort of see an S curve, that there are some firms that are going to be quick to lay off people. Then you get to the middle part, and then you get to, where the process is done. So far, it looks like a very truncated S curve. And yes, we expect them to continue to lay off, but the question is, are they going to do it so fast that, the Fed says, oh my God, we should have cut in May, we're way behind. And I doubt that's going to be the situation that they face. I do think they've been overly hawkish maybe for a while, but it's not going to bite them in the back, so to speak.
Veronica, what do you make of that? Like, how does this look if there were to be layoffs, the speed of it?
Yeah, I mean, we're not talking, I don't think, of course, about a 2008 or COVID or anything. The unemployment rate, which has come up, from a low of 3.4 already to 4.1, maybe going 1.5% more, something like that, a little bit above 5. But I think that would be enough for the Fed to say that's an unexpected weakening of the labor market, at least to be cutting every meeting. We're expecting 25 a meeting every meeting. We're not expecting 50s or 75s. So it wouldn't be the most dramatic downturn, but it would be a recession, run-of-the-mill recession.
Steve, I wanted to push this through the FX market, which is tremendously difficult to do at the moment. You've put in your research, half the time we're thinking about Trump trades, broadly dollar positive. The other half, we're talking about this deceleration in the economy, which might be dollar negative. How are you thinking about things? Do you focus on one half versus the other, or do you try and do both at the same time, Steve?
Well, you have to try and do both at the same time, while being cognizant that, every day's data matters. And I think overall the Fed cycle and the weakening of the economy is going to end up being the dominant force. Partly it depends, assuming that Trump wins, which is the assumption that most of the market is making right now. Assuming that he wins, the question is what he chooses to emphasize. He can go the cut taxes route and the, sort of high tariff route, which I think much of the market would think is, inflationary over the longer term. He can go on the drilling route, cheap gas route, which would be disinflationary. So I think the market is going, till we get to that point where we actually understand, assuming he wins, what he's going to do, the market will probably emphasize the activity side rather than the, rather than the political side, unless he makes this absolute commitment that the first thing he does is going to tariff up China or something.
Got it. Steve, thank you, sir. Steve Englander there of Standard Chartered in the FX market. Veronica, I just want to finish with you on that if we can. I'm sure clients are asking you and the team about it. What are you saying to them about November?
Yeah, we're going to get only more questions as the months go on. I mean, I think, we don't have a lot of concrete details of either, a Trump victory or a Biden victory. Obviously, it's going to depend on what happens in the House and Senate also. But yeah, both scenarios look pretty inflationary, look like wider deficits for sure.
If you had to say in percentage terms, is it like 50% on the Fed, the questions right now, and 50% on the election?
Still more heavily the Fed, I'd say.
Still the Fed?
Yeah.
Okay.
The political side is just a lot of drama still for now, maybe.
Veronica Clark of Citi. Veronica, it's good to see you, as always. Starting to feel vindicated about the incoming information. Certainly not what anyone would wish for, but ultimately that deceleration coming through in the labour market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Houston is grappling with blackouts, blocked roads, internet disruptions, and spotty access to gas in the aftermath of Hurricane Beryl. More than 1 million homes and businesses are likely to be without power until at least tonight, according to the region's main electric utility. Beryl, now downgraded to a post-tropical cyclone after striking Texas as a Category 1 hurricane, is carving a path to the northeast. The National Weather Service warned of flash flooding risks for northern New York and New England today. Microsoft and Apple have given up the chance to be observers on OpenAI's board. The move comes as global antitrust regulators step up scrutiny of big tech's influence on AI. Microsoft, which has invested $13 billion in the creative ChatGPT, sent a letter to the startup announcing its withdrawal from the board. And BMW is pulling away from its EV competition. While its German rivals struggled with sales in the second quarter, deliveries of BMW's battery-powered models surged 22%. That contrasts with a 25% drop for Mercedes and flat EV deliveries for Audi. BMW has rolled out several new battery models, moving earlier in the EV shift than many of its competitors. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate this morning. Thank you very much. Up next on the programme, setting you up for the day ahead. It's a busy one. We'll be back in just a moment. You're watching Bloomberg Surveillance. Looking to make it the 7th day of gains on the S&P 500. We are firmer here, higher, adding some weight to the S&P. We're up by 0.25%. In the bond market, yields are a little bit lower. We're down 2 basis points. The 10-year, 427.83. As we count you down to the opening bell, about 38 minutes away, here's the trading diary through today and through the rest of this week. At 10 a.m. Eastern, Fed Chair Jay Powell wrapping up his 2-day congressional testimony. Plus, throughout the day, more Fed speak. We'll hear from Goolsbee, Bowman and Cook. On Thursday, tomorrow morning, it's the big print, 8:30 Eastern Time, US CPI. Another round of jobless claims. Don't miss the claims either. This is important. Are we starting to see a sustainable, more durable break in claims higher? That would, I think, be concerning for a lot of people on the FOMC. We'll also get Delta earnings, which is worth watching as well. And then we're looking ahead to this one right here, which arguably for some of you across the nation outside of Wall Street is the event of the week. It's President Biden holding a solo news conference when the NATO summit ends. Look out for that on Thursday afternoon. Friday brings us PPI and UMich Consumer Sentiment Survey data. And then we kick off Q2 earnings. We get numbers from JPMorgan, Wells Fargo and Citi. Lisa, on that screen, we've talked about this a million times. What stands out for you now?
I think it's got to be CPI and jobless claims, just simply because we really understood today from a number of guests why the rate cut timing was so important. They're kind of using that as the benchmark for when to start broadening out the trade away from the Magnificent Seven into some of these other places. So to me, that's why I find potentially what we get on Thursday so interesting.
On Thursday, for me, obviously, it's going to be the press conference. This bar Biden needs to clear. But before that, this evening, he's also going to be hosting a dinner for these allied nations and the alliance. It's at 8 p.m. And you can't joke about it anymore because the president told governors, according to reporting, that he was going to wind down activities and not be a part of them after 8 p.m. And what European diplomats are saying to us is, well, we wish we can focus more on the substantive issues at play at NATO, but we are also focusing on the health and mental acuity of the President of the United States.
This is the part of the problem, isn't it? And two things you talked about, how high the bar was. The bar is so low. for the president to clear. Just get through a news conference without any gaffes. For most people, that would be OK, but based on how this has been going, it's not. And on the substance, the fact that we're talking about a sitting president's bedtime and not two wars taking place at a NATO summit is just bizarre.
It's the reason why people have a hard time taking it seriously in terms of market action, simply because we're not talking about policy. We're talking about, I don't even know who's going to be on the ballot at a time where there's a coalescing of Democrats, but not necessarily confidence that comes with that.
And we heard that from the congressman today, the fact that he's going to stand behind Biden, but he did at the end there say, well, I kind of wish there was more of a robust primary leading up to this point. But now that he is top of the ticket, this is what some are feeling. We're just going to have to go with it. But they're seeing the polling. And what they're seeing is this potential, we heard from Senator Bennett yesterday on CNN, is landslide Trump victory. And now they're starting to think, well, career risk, maybe I get ahead of this.
Yeah, it's quite a 24 hours coming up for the world of politics and the world of financial markets as well. Coming up tomorrow to help navigate some of this, we'll catch up with Russ Kostrick of BlackRock. We'll speak to Sarah Hunt of Alpine Saxon Woods, David Kelly of JPMorgan Asset Management, and Steve Rasciuto of Mizuho. It's CPI day tomorrow and a whole lot more for the President of the United States from New York City. This was Bloomberg Surveillance.